We head towards the Fed. The pound, 125.21, down by 0.3%. That on the back of the disappointment of that October GDP print. The weather had an impact, but weakness going into the fourth quarter then, Tom.
European futures are flat. FTSE 100 looking to add just 2 points. The DAX is looking to lose about 7 points, but all major indexes currently just flat. The CAC pointing to losses just about 0.1%.
Okay, so that's what we see across futures then. Futures looking pretty flat, actually, as we head towards the start of the European trading day. And we see the FTSE 100 opening pretty flat. Here's the weakness in the pound. Let's focus here while we give the equity markets a moment to settle down. This is the weakness in the pound that we've seen as a result of that weaker GDP print than anticipated. The October number coming in minus 0.3%. And that's the first building block, of course, of the fourth quarter. So we'll see where that takes us in through the winter and what that does to the willingness of the Bank of England to push back against rate expectations next year. Maybe that makes them less willing. Will we see any of those dissenters from last time become part of the hold lobby at the Bank of England, more dovish? That was certainly one of the parts of the conversation with Pooja Kumra a little earlier on. So that's where we're seeing some of the action in the dollar, in the pound, the euro just a little weaker. And here's the sovereign bond column. I'll come back to equities in a moment, but this is an area of interest as well. As a result of that weakness in the data, we see the two-year UK yield dropping by 7.3 basis points. This is after a move of 11 or so basis points on the 10-year yesterday. So we've certainly seen outsized moves in the UK, in the gilt markets versus the rest of Europe over recent days. And we continue to see that based on what we're seeing here on the GMM, those moves in the UK bigger than elsewhere. So those are the two markets that are on the move. And also I'll add in commodities because we saw that iron ore movement downwards. And here's what the equities picture looks like right now. Pretty mixed, pretty flat for most of them. The Spanish IBEX down by 0.2%. Tom, what do you see in the sectors?
Yeah, top line across your benchmark, not a lot to look at. But when you peel back the sectors, there is a lot more interest in terms of the story coming through. And we flagged the fact that energy and basic resources will be likely to be under pressure this morning. That is exactly how it's unfolding again. You look at what's happening with WTI and Brent, the pressure that came through yesterday on increased output coming through from Russia, from the US, and of course that concern about demand. The last time I checked, WTI was about $68 a barrel, well below that 70 level then. And as a result, energy is down 0.5%. But basic resources, you look at the pressure coming through from iron ore, from copper today, also a continuing theme given the lack of additional stimulus coming through from China. That sector under pressure today, down 0.6%. On the upside, it's technology, adding gains of 0.5%. The lower yield environment, of course, helpful for tech in that sector. Financial services gaining just 0.1%. Industrials adding 0.2. Healthcare also gaining 0.3%. But the pressure coming through, as I say, for basic resources and energy across the top line, you are flat. The FTSE 100 managing T-count gains of 0.1% despite the pressure coming through for energy and basic resources. 7,550 on the FTSE 100. Anna.
I mentioned part of the gilt curve. Let's just get a fuller check of what's going on there. We are seeing movement lower in yields across the curve. I'm looking from 2 years all the way out to 50, and we see those yields coming down this morning. This on the back of that weaker than expected GDP data that we got out this morning. That's certainly having adding to expectations of cuts next year. Does it influence the Bank of England's willingness to get involved in that conversation as we head towards the end of the year and we look ahead to that meeting? Clearly, that is going to be something that we talk about a lot as we head into tomorrow. But Sam Unstead joins us now from the Markets Today blog, and their team, of course, will be all over the UK story. We've talked about that a little bit. We're just seeing those UK bonds gaining at the open, the 10-year yield dropping 6 basis points or so. That's the UK story. But a little bit later on today, we're going to have to focus our attention stateside, aren't we? Because we're going to have a Fed decision, and we are looking there as well for how much pushback we get against cut expectations from the Fed.
Yeah, and I think the expectation is that we will still see that, right? I mean, it's actually interesting what you're seeing in the bond market, particularly the UK bond market today. That's quite a significant move. Very often, when you head into these periods where you have multiple central banks kind of reporting, you'll get a kind of holding pattern. But it seems like the GDP data has kind of fed through. I think with the Fed and with the ECB and even with the Bank of England, even with the moves today, the likelihood is they will still push back a little bit on those cut expectations for next year.
Okay, and as you referenced the gilts, just noting that the 5s and the 10s now below that 4% level. The 10s have been for a week or so at 390 now on the 10-year, 398 on the 5-year. So the 5-year just getting below 4% in terms of UK gilts as yields fall lower. In emerging markets, Javier Milei, he started his shock therapy with a pretty significant devaluation of the peso.
He did, but I think so. This is kind of an interesting thing. So, as obviously, if you're watching this from afar, huge moves, shock therapy, as it's being called for the Argentinian market. But a lot of this has already been priced in because there was so much anticipation for him coming in and the kind of moves they may make. So, actually, what you heard from a lot of analysts and a lot of strategists overnight was that there's not quite enough detail in there. This isn't quite as much as we expected, even though, indeed, as you say, there's a massive devaluation of the currency and a lot of spending cuts. So, it may well be that the markets are looking for a little bit more detail.
Okay, thanks very much, Sam. Yeah, I was looking at the Argentinian CDS. Not sure there were enough spaces for all the figures that were needed for the move that we saw there. But Sam, thank you very much. Sam Unstead from our Markets Today blog. You can read that blog, of course, if you go to the front page of the Bloomberg UK website. You can find it there, or go to TLIV Go on the Bloomberg terminal.
Okay, we are going to take you to break now, and we're going to cross over to Dubai, where, of course, you have had this agreement. It looked very precarious just 24 hours ago or so, but we're going to bring you live pictures of the closing plenary of the COP28 UN Climate Conference, which, of course, has run over the set deadline to get this deal. A deal has now been agreed to transition away from all fossil fuels for the first time. We will listen in briefly to that.
Is unlike in the past when we have all tried to hide behind the term consensus. We have tried to use that to protect our national positions. This is the first time that we have perhaps come out of our respective comfort zones and tried to look at the bigger picture. And we have all along said that consensus has to be on the basis of science. When the first draft was presented, we expressed, and we didn't mince words, that we were extremely disappointed because it didn't capture the ambition, and the North Star that you had talked about, I said, was now hiding behind dark clouds. I think over the last 2 days, thanks to the work and your initiative and that of your team, and our collective will, because at the end of the day, this is a member-driven process, and we have to really decide what we want to achieve. We have been able to remove those clouds. And what I see as significant is that this is the 28th COP. Between COP1 and COP27, we basically moved from one COP to the other. And here, I think we have not just transitioned, there is...
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything. Today, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg surveillance. The Fed decides. Today on Bloomberg.
Welcome back. This is Markets Today. 10 minutes into our European trading day, showing very modest gains and in some places no gains at all across European equity markets. But perhaps to be expected on Fed Day, waiting for the Fed's rate decision later on today. US futures, with that in mind, up by 1 or 0.2% on E-minis and Nasdaq futures. Let us get a check on the individual stocks that are moving this morning. Joe Easton has a briefing for us. Joe.
So we're starting with a really interesting move here in the UK. We've got Entain at the top, up around 5%, a surprise announcement that the CEO is standing down after less than 2 years in her position. Now, this follows a couple of bits of news for them. They recently paid a big fine for their tax issues over in Turkey, and also deal between the company and MGM over in the US. That seemed to break down, and activists have been calling for a management change, and they seem to have gotten what they want there. So that stock is one of the best performers in the UK today. In terms of the Zara owner Inditex, the sales slowdown at the company we had in stocks to watch, but it was still up around 15% in terms of their revenue growth across 9 months. So we're still seeing that stock up around 0.5 percentage points at the moment, 0.3% now. And then a couple of other retailers to mention. Colruyt over in Belgium. This one had sales after the close yesterday, pretty strong from that one. It's budget supermarket, gaining around 4%. And B&M, the budget retailer here in the UK, the discounter, that one is a share placing. So that one is declining. An investor offloading a lot of stock at a discount for that one. We're going to flip over and look at some auto stocks. There's a whole swathe of autos notes out today. The autos analysts are putting out their previews. So we had Ferrari and Porsche. Ferrari downgraded HSBC, and also at Exane BNP Paribas. Now, Exane adding to the HSBC concerns around potentially the luxury end being overpriced in the car market. And Porsche, as we said, gets that buy rating over at HSBC as pricing concerns overdone. Exane is also downgrading Mercedes-Benz, so that one falling 0.8%. They say that the pricing also similar in the luxury kind of space. They prefer Volkswagen there. And I'm hearing talk of a potential rating on Continental. So that one is rising, but I'll wait to confirm that one before we report that. I think we're out of puns on the autos, so a couple of them skidding off tracks this morning or putting the brakes on, something like that. But we'll flip over to the final board. There's a couple of other individual stocks. So we got LVMH, that one downgraded at JPM. We had it in stocks to watch. Nell, this one is in energy. They've lost a couple of massive orders, according to the company in a statement. And two bits of M&A. Pagero over in Stockholm. This is a online payments firm getting a bid at a premium. And Impellum, the latest UK mid-cap company to get a takeover offer. Its recruitment, temporary staffing, that one up around 30%, among the biggest gainers in the small caps this morning.
Joe Easton from our equity team, thank you very much indeed. Let's get back to these markets then and reflect on the fact that, well, right now, European markets are adding just 0.1% as we lead up, of course, to the Fed decision. US futures currently looking at gains of between 0.1% on the S&P E-minis and 0.2% on the NASDAQ. But the context, of course, is that the S&P has gained about 20% year to date. The NASDAQ has gained about 50% year to date. So let's get the analysis, the view, as we project into 2024 with Neil Wilson, co-CEO at EJF Capital, where he also serves as the co-chief investment officer of EJF's private markets products. Neil, thanks for joining us in the studio this morning. Let's get your views then, top line on these markets. How much is priced in, do you think, to US stocks as we look into 2024? Is there further room to rally?
There is, but I do think the markets are being a bit hopeful. I think they've priced in continued immaculate disinflation that we've seen this year, where you've had the wage inflation's come down, goods inflation's come down, but the CPI number yesterday showed that services inflation is still an issue, and so I think that today you'll hear Powell talk about, we'll stay pat, the Fed will stay pat, but it's really about what the press conference is today at 2:30. That's really going to be the interesting thing. And looking at the summary of economic projections, what do the dot plot looks like? Long term, it means nothing, but short term, it could affect the market, because I think the market is expecting 100 to 125 basis points of declines next year, and I think that's hopeful.
Okay, and so it's one of our colleagues, Ben Ram, on Markets Live blog, suggesting that we could see the Fed come back with, well, maybe we'll give them 50 basis points next year, and then we'll see yields move and we'll see the dollar move. And that's kind of the volatility, I suppose, we should brace ourselves for today if we do see that kind of pushback.
I think that's exactly right. Right now, as of the last meeting in September, they talked about 50 basis points. That's what the dot plot showed. This will be the first time, 3 months hence, where they'll be projecting for the next year and for 2025. And I suspect it'll stay at 50 basis points. I don't think you'll get much action. But what if they said 75 basis points? Then the market's gonna rip on the short term. Right. But I think long term, you're looking at 50, 75 basis points next year. 100 would be, and I think it'll be the back half of the year. I mean, the CPI was a pretty strong number. I mean, jobs, it's almost 200,000 new jobs. And what history tells you is they don't start cutting it until it's closer to 100,000 jobs.
Look, we speak to a lot of analysts based here in Europe, based here in London, about their views around a soft landing in the US. You live there, you spend time there, you're based there. Does it feel like a soft landing economy for you?
It does. It does. And I do think that there's a couple big factors that show that there's still stimulus coming down the pike. I mean, Biden's signature legislation is the Inflation Reduction Act. Terrible name, but it's very stimulative. But in fact, it's huge for the renewables business, and it hasn't come online yet. You also had the Infrastructure Act that was also 2022, and then the CHIPS Act in 2021. All of those are stimulative, and except for the CHIPS Act and the Infrastructure Act, they're not coming online yet. And so I think you still have an ability to have a soft landing. That being said, the other side of the coin is, at least on the banks, where we focus a lot of time on, the lending has really come in. It's very similar to Europe in the sense that loans are just not being made on a scale that they were prior to the pandemic.
And so the higher interest rate environment having the impact that you would expect it to have, I suppose, on that sector in that sense. I mean, we spoke to the European Banking Authority earlier on in the programme, talking about the European context for banking, and he was telling us that that they've seen a real drop off in loan, not just the willingness of banks to lend, but also the willingness of borrowers to borrow. Do you see any change in that in the US if we continue to expect that rates have peaked?
Yeah, no, I think, again, I think it is a contrast to Europe a bit. I think there is still more interest in taking out loans, and I think it's because of those three acts I mentioned. And also, the consumer, 70% of the economy, the consumer is still a little bit more constructive than here in Europe, as I sense things.
You talked in your first answer about markets being a little bit too hopeful, or at least pricing in a lot of hope. It sounds like you have a bit of caution and you're a little bit skeptical about how much hope is priced in. How do you express that caution in your portfolio?
Well, I think the way to look at things is if rates are higher for longer, what areas are interesting? And I do think areas such as renewables have been beaten down in America. I'm on a long-term, medium-term basis, that's an interesting area because, as I said, the Inflation Reduction Act is very stimulative, $500 to $900 billion.
And that's not priced in yet.
Not fully. It's not in the renewable space because the rates have been so high. But I think that hasn't come online yet. The government still has not put out. It's tax credit driven, so it's very stimulative. That process hasn't even been put online yet. So I think that's an area to be very interested. I think construction has been pretty strong, and I think then on the other side you have to be wary of real estate unless you're being opportunistic.
Yes, exactly. So talking about real estate, where do you focus in on the banking sector to get some of the opportunities at the smaller end, but without facing the risks around the real estate portfolios?
Yeah, so the risk of the real estate portfolio is really in the regional banks. There's really, as I said before, there's like 3 banking systems in America. The money center banks, those are the massive banks. The regional banks, and that's where I think the risk is on the real estate exposure, and then the small banks. Small banks, their real estate exposure tends to be owner-occupied, the dentist's office, the dry cleaner. That doesn't pose a lot of risk because you're getting personal guarantees, and also underwriting standards have been very, very strong in that area. The real risk is in that regional bank space, so that's an area where we've tended to be short because there you have big projects that are not dictated by can the bank push the loan down the road or the interest down, just be interest-only payments, for example. It's subject to CRE, which is in structured product. There's rules that will just dictate if the loan-to-value is a certain rate, you have a problem. So I think that's more structural, that's more problematic. For me, it's pretty clear on real estate how to play it.
And US politics comes firmly into focus in 2024 as we lead up to that election. Of course, we have the primaries to focus on, and the polls, of course, suggesting that it's a very close tie, if not Trump having an advantage over Biden. And we wait to see if Trump is indeed the nominee. How are you thinking about threading the politics of the US into your investment decisions? What are you looking for in 2024 as potential pitfalls, potential hurdles, or potential catalysts on the political front?
Well, certainly the polls, and we spoke about this on the break, I mean, the polls are national polls typically that get cited. And that would suggest Trump is clearly the nominee and Biden's the nominee by default. And so in that situation, I think what you have to worry about is, what's going to happen in Congress, because in America, in order to get anything done, you need both houses of Congress and you need the presidency. And so to change, for example, the Inflation Reduction Act, to change that, the Republicans would have to win all 3. And I don't think that's very likely. I think Trump will have a very hard time being elected president again. So I think in terms of our portfolio, you just assume there's going to be split government because the Senate will probably flip to the Republicans because of the way the calendar works. A third of the Senate's up every 2 years, and it bodes well for the Republicans. The House it's so close right now, it's hardly functional. That could definitely flip to the Democrats. And I would, if you had to pick right now, you'd say Biden would win. I wouldn't count out Nikki Haley, though. I do think there's a way to draw an inside straight where she just got, last night was a very important, she got an endorsement from John Sununu, who's the governor of New Hampshire, and he's very popular in New Hampshire. She's running second, and if Christie drops out, she has a chance of beating Trump in New Hampshire, which is the second primary. Then guess what the third primary is? South Carolina, her home state. So it would be hard for her to do it, but you never know.
But you never know. Neil, thank you very much. Thanks for joining us. Neil Wilson, co-CEO at EJF Capital, keeping US matters in focus as we head towards the Fed and reminding us of the US politics process already in play. Coming up on the program, valuation takes off. We'll bring you more on the tender offer that's seeing the value of Elon Musk's SpaceX reach new heights. That's next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Markets Today. Now, Bloomberg has learned that SpaceX is to sell insider shares at $97 apiece in a tender offer, a price increase boosting the value of the space and satellite company closer to $180 billion. The world's second most valuable, closely held startup has been discussing an offer in the range of $500 to $750 million. Bloomberg's Subrat Patnaik joins us then with more details. So a lot of numbers there, Subrat. What does SpaceX's value jump then, if we can conclude that from this partial offer? What does it tell us about the company and about Musk?
So it's definitely a net positive for the company. Valuations going up. And it is not a proxy for the Tesla stock usually, but investors in Tesla are very, very concerned about Musk's other ventures, be it Neuralink, be it Twitter. So in case there is a turmoil in any other section, they're always kind of worried, and the Tesla shares, the bulk of the money that gets produced for Musk's ventures gets pressured. So this definitely is a positive news for all of them.
Another development within tech is Netflix breaking out viewer numbers for its individual shows for the first time. The implications of this for that company and streaming services more broadly.
So it's very interesting because Netflix will be the first one to give such a detailed report about viewership data. What we now know is what everybody watches, which is great for us, but this is also very important data for creators, and this comes just after the Hollywood strikes, and this data really lets creators and creatives know what shows are working and what shows might need more help.
Yeah, big changes there, big developments in terms of the world of streaming and whether or not Disney and others follow suit. Bloomberg's Subrat Patnaik, thank you very much indeed for the update there on the valuation around SpaceX and that decision for Netflix, by Netflix, of course, to break out its viewer numbers. Coming up, the UK economy shrinks more than expected in October, of course, as rate hikes hit. We're going to dig deeper into the data and look ahead to tomorrow's Bank of England rate decision. UK gilts are rallying. The pound is under pressure on the back of that data. You're seeing 3.92 on the UK 10-year, yield down 4 basis points. We got more analysis and context after the break. This is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Was going to keep Rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg. This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. European stocks inch higher as markets await the Fed's final decision of the year. The ECB and Bank of England both follow up with their policy announcements tomorrow. Two-year gilt yields are near a 6-month low as data shows the UK's economy contracted more than expected in the month of October. Plus, COP28 breaks new ground. The climate talks end with the first global commitment to transition away from fossil fuels. Really fascinating developments then in Dubai. We've had analysis from our colleague Jess Shankelman on the ground with the rest of the COP28 team providing coverage for us. That's part of the story today. But of course, from a markets perspective, in the very near term, we're really waiting for the Fed.
Yeah, the build up to that Fed decision with markets still pricing in over 100 basis points of cuts. And to what extent will the dot plots push back on that market pricing is going to be key, as well, of course, as Jay Powell's press conference comes 30 minutes after that decision. We had data out of the UK reminding us of the softness here, the stagnation in terms of this UK economy, the contraction of 0.3% in the most recent month. And we are also, of course, tying in the China news, and Chinese stocks sold off once again today on the back of the fact that there wasn't more strong commitment around the fiscal support coming through from central leaders over in Beijing. But that hasn't really weighed too much so far in the European session, which is relatively bright, given the modest sell-off that we saw yesterday, adding gains so far in the session of about 0.1%, slightly brighter than the futures had signalled. The DAX is back in positive territory, adding 24 points at 16,816. The budget has been resolved, and we'll get the details from Oliver Crook on the ground in Berlin on that. The FTSE 100 with that UK data, with expectations that maybe the Bank of England will be pushing through more cuts next year than had it been expected on the back of the softness of that data. The FTSE 100 adding gains of 0.2%, and so far looking through some of the weakness in terms of basic resources. Talking of which, let's flip the board and have a look at sectors then, because we have seen pressure on and across the commodity space, whether it's oil or copper or iron ore, and iron ore is currently down a little over 1%. Basic resources then under pressure as a sector. Energy as well. Oil took some thumping hits yesterday in terms of, and as a result of increased output coming through from Russia and the US. And across your sectors now, energy down 0.4%, but it's telecoms taking the biggest hit, down 0.9%. Top of your list is chemicals, travel and leisure as well, eking out some pretty decent gains so far in the session, Anna.
Okay, so that's what we're seeing in the session so far, 32 minutes in. Let's get to the UK macro story. The economy shrank more than expected in the month of October as elevated borrowing costs have started to take their toll. The figures add to fears that Britain is stuck in a long-running stagnation. Let's talk to Dan Hansen of Bloomberg Economics. He's got his views, can take us through them on what this data means, where it takes us. Dan, let's just deal with some of the easy-to-deal-with things. I mean, how many one-offs are there? I seem to remember, I mean, the weather always plays a role. Was it warm in October, people didn't buy coats. What was the weather story that we need to sort of strip out of these data?
It's always the case, isn't it? The monthly GDP numbers, we blame the weather. But this time it was wet weather. Okay. So that's one of the reasons why possibly it was a little bit weaker than expected. I think if you look at the sectoral breakdown, though, it looks broad-based, this weakness. It doesn't look like a set of one-off factors. The weather might have played somewhat of a role, but I think looking at it this morning, it was weaker than we expected, weaker than all economists expected. As I say, it was pretty broad-based, that weakness.
And does it change you and your view and the team's view in terms of where the BOE lands? Does it bring it forward?
Yeah, that's a really good question, Tom. So I think we've got the first cut coming in August next year. Now, you look at this data, you look at this data, you look at what we had yesterday on the wage data. Obviously, the risk is that it's a little bit earlier, but I think the thing that we have sort of weighed in our forecast, and we've got a very weak GDP forecast, but it's set against a strong inflation forecast, and it's sort of how do they balance that, and where do they land? Now, I think our forecast says they hold their nerve, they being the Bank of England, hold their nerve, and they really focus on the inflation story. But you have to remember, election year, if the economy is weaker than they expect, the risk is it is shifted forward. Now, how much will it be shifted forward? I think the earliest it could come is May, because they'll want to see the March budget. There's some hopefully good inflation data coming in April, May next year. So they're going to want to see that come through before they go ahead and cut. But I think May's the earliest point, but at the moment we're still on August.
Okay, and just looking at where we are on CPI, I mean, we're at year-on-year figures of around 4.6% for the UK. So, yes, if you're the Bank of England and you're thinking that's still way above target, isn't it? It's way above a 2% target. But is it, where is the level that you think really makes a difference for the Bank of England? What kind of inflation can we get down to where the Bank of England says, okay, now we really need to focus on the weak growth story, even if inflation is higher than target?
So I think over the next few months, probably to March, we think we're going to stay at 4.5. April, May, you're going to get a pretty big drop. Because if you remember this year, we had this massive spike in core inflation. If that isn't repeated in the way the annual comparison works, we're going to get a drop down to around 3, maybe even 2.5% if we're sort of with a fair wind. And I think that's the point, as I said to Tom in the previous question, that's the point at which they'll feel comfortable that with a weak economy on the other side of the trade-off that they're looking at, they'll be okay cutting rates potentially.
But inflation has to have that 3 handle for the BOE to take that comfort and maybe to move the dial for those 3 key hawks on the MPC. Just as you look out to 2024, are you revising and changing your forecasts on the growth picture for the UK?
No, I mean, on the growth picture, what we had today is very sort of consistent with what we've got in our forecast. We've got 3 quarters of contraction, Q4, Q1, Q2. We think the second half of the year will look a lot better and things will begin to pick up. But I think, given what we've seen today, we see no reason to change what we see at least over the next 6 to 9 months, which is some small contractions.
And how does the fiscal side weigh in here then, Dan? We've had an autumn statement, of course, that had some small fiscal giveaways, some headroom was found. Heading into March, we're going to get a budget there, and as you say, this will be influenced by the fact that the electoral calendar takes us closer to an election than we are from the last one. So what does that lead us to expect fiscally?
I think you've got to expect they're going to cut taxes in some way, shape or form. And actually it goes back to the previous question as to why the Bank of England's going to wait. They're going to want to see that budget because depending on what happens, we've got interest rates coming down. That could potentially create some headroom. We've had some news on the migration front that could affect the economy's long-term growth prospects. So when you're thinking about the headroom Hunt might have, it's possibly has a little bit more to play with. I think there's always some fiscal jiggery-pokery going on, isn't there? And they'll find some way to cut taxes and try and give a near-term boost to the economy, even if it means this story about in the long term where spending cuts aren't deliverable, they sort of double down on that story and squeeze spending later on in the forecast period. So going to the Bank of England, they're going to want to see that as well before they think about cutting interest rates.
Okay, let's hope the weather doesn't get in the way. Dan Hansen, thank you very much indeed. From Bloomberg Economics, hold on to that view that the Bank of England cuts in August, but with a risk that it is pulled forward to May, but no earlier than May. Thank you, Dan, for the analysis and the context. Now, government officials say the German coalition has finally reached agreement on their budget for 2024. Talking of budgets, let's get more then on this breaking news. It broke about an hour ago from Bloomberg's Oliver Crook in Berlin. Ollie, what do we know then at this stage about the deal, about the agreement, and how it sets up the budget for next year for Germany?
Yeah, Tom, we can't blame the weather here. So basically, for the last month, this coalition has been, negotiating for how they're going to plug this, what we understand to be a 17 billion euro hole. We understand they've finally got a resolution. They've been doing these sort of all-nighters and discussing overnight, and they finally clinched it last night. We're going to get the press conference out in about 2.5 hours that will hold really the details of how they intend to do this. And this is what everyone is really waiting for, because there are only so many ways you can pay for things as a government. You can either cut spending, which is a difficult one to swallow for the Greens, and Schultz over the weekend at his party Congress saying that we will not dismantle the German welfare state. So that's going to be unpopular with them. You can raise taxes. That's often not popular with a lot of people, but certainly not the finance minister, Christian Lindner. And then the third, and this is going to be the most interesting thing to look out for, could they call for a suspension of the debt brake yet again on the grounds that there is still a crisis in the form of the Ukraine war? And could that then put the funds that are allocated to Ukraine for military spending and also dealing with the refugees that have come from Ukraine, there are over 1 million that have come to Germany, could that be then put aside, and could that plug the hole? And what will also be very interesting is how do you then sell this politically for all three of these parties? This is a huge loss for the government, but how do you ensure that the communication, there's not one big loser within them?
Yeah, that's really interesting. Then this could have knock-on geopolitical impacts, couldn't it, Oliver? Do we have any idea of where the economic impact of this is going to be on Germany? As you say, we're waiting for some of the detail as to how this is done. But in terms of what we know so far, we were talking to Pooja Kumar of TD earlier on, and she was saying that's exactly what she'll watch, the ECB will watch, as to how much this reduces any fiscal boost in Germany.
Exactly. So there's the one thing that has already sort of gone into this market and has affected it economically, which is the uncertainty that this created for a sort of month at least, right? And we now understand that the budget won't even get passed until next year, and there's still a number of hurdles it needs to cross. So there's the uncertainty, and Deutsche Bank, when this first sort of happened, was saying that this is already going to shave off 0.5 percentage point onto growth, which is enough to make a contraction next year from what was supposed to be a year of growth. However, if we do see some spending cuts and we do see some reduction in shifting in subsidies, how will that affect the private sector? Will they change where they place investments? And this is going to be sort of the big question that we're going to be looking out for, particularly at a moment when Germany is really, they're perhaps more risk averse than many other economies, certainly than the United States. So the more uncertainty that there is, and there's less there is of matching money and sort of clarity from the government of where they're going economically, the private sector is really going to pull back. So that's what we're going to be watching for.
Thank you very much, Oliver. Bloomberg's Oliver Crook with the latest there in Berlin. Coming up on the programme, we'll get back to the events in Dubai. COP breakthrough. The climate talks in Dubai end with a global commitment to transition away from fossil fuels for the first time. We'll get the details just ahead. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Welcome back. Happy Wednesday. Fed Wednesday, of course. This is Markets Today, and we are seeing gains of just over 0.1% across European trading and European equities so far. Let's get back to Dubai. Of course, the developments there when it comes to COP28 and the climate talks, breaking new ground with a commitment for the first time to transition away from fossil fuels. Let's get the details then with Bloomberg's Akshat Rathi, who joins us from the conference in Dubai, of course, has been on the ground covering this story for us. Akshat, how significant is this? What are the details of this deal?
Well, this is the first time in 28 years that this has been agreed, the transitioning away from fossil fuels. We've known for nearly 30 years, the science has been clear that it's burning of fossil fuels that causes greenhouse gas emissions, that causes climate change. But until now, all the 200 countries had never agreed to mention the transitioning away from fossil fuels as a solution. We've known it, but now countries agree. And this should send a market signal. We know that the Paris Agreement in 2015, when it was signed and set the temperature targets that we talk about, ended up in boardrooms as net zero targets. Now, this deal is likely to do the same, as many people call it, the beginning of the end of the fossil fuel era.
Okay, a nice summary for us, Akshat. If we just think about what's happened here behind the scenes and what the latest developments, what they really mean then, Akshat. We had heard that Saudi and others, those economies, of course, really exposed to fossil fuels, have been reluctant to sign the previous version of the statement. Well, then they got their way and then others were reluctant, and these things went round and round for a while. What do we take away from the fact that we had to move away from phase down or phase out towards transition? I mean, is that material? Does it suggest that more power stays with the fossil fuel producers than some had wanted? What do we take away from this language?
Well, United Nations summits are really complicated when you try and get a consensus, right? There can be no party, no country that disagrees on the outcome, and that's what we've got. We've got a consensus, but it's very complicated to get there. Now, as soon as we knew that the conference was going to be in Dubai, in the belly of the beast, so to speak, in the place where fossil fuels are produced and the place which they are dominant in the economy, green groups were really angry. They thought there is no way you can make progress on climate goals when you are in the place that is making the problem worse. And so the President, Sultan Al Jaber, had a really hard challenge ahead of him. And now we've seen, as you said, there's been a lot of yo-yoing through the year, but especially over the last 2 weeks. But we do have a deal. And what does it mean? Well, I think Jennifer Morgan, who's the Germany's climate envoy, put it best. She said, it sends a signal that investment in renewables are the thing that are going to be profitable in the long term, and that if there are continued investments in fossil fuels, those could become stranded assets. This is the signal that 200 countries are sending to the market right now.
Okay, and that's a signal that certainly you would expect investors to pay attention to. Who are the winners and losers then in this Akshat, as we also have to consider the loopholes written into this deal?
There are a number of them. So first of all, the transitioning away from fossil fuels is only in the energy system. So that leaves out plastics, that leaves out agriculture, that can make up to about a quarter of oil and gas demand. So that's one. The other one is that there's a clear statement for accepting transitional fuels. Now, that's usually code word for natural gas. And so there is an acceptance, perhaps, that natural gas has a role to play for longer. And so there are some get out of jail clauses for the fossil fuel industry. And of course, when these deals are made, compromises have to be made. So some fossil fuel interests have won out. But overall, this is because of its unprecedented nature as being the first time that fossil fuels get this kind of language. It still is a pretty big, strong market signal.
Okay, a big signal there coming from the COP28 delegates. Thank you very much, Akshat. Thanks for bringing us the story. Bloomberg's climate change reporter Akshat Rathi with the details from Dubai. Now, on to something different. Belgium is trying to stop criminal gangs from turning the country into an export hub for illegal narcotics. The recently appointed drugs commissioner has told Bloomberg that criminals are manufacturing synthetic narcotics in the country and exporting them around the world. What is being done about this? Max Ramsey is in Brussels for us and joins us now. Max, how big a problem is this, and what is Europe trying to do?
Well, really, Anna, a market story of a different kind, because this is a market that has been growing, the illegal drugs market, despite authorities' best efforts to stop it. And that's true in Europe, but also globally. But really, the interesting and concerning thing here is to do with drugs being produced and manufactured now in Europe. So this is criminal gangs manufacturing synthetic drugs, so chemically derived drugs, which would include things like ecstasy pills, but also amphetamines, methamphetamines, in the bloc. These then would be consumed within the bloc, but also even exported. So going against this, perhaps more traditional idea of drugs coming into Europe. How are they trying to stop this? Well, they think that a lot of the criminal organized crime related to drugs is concentrated in Belgium, also the Netherlands, of course. These are two countries that are very important for European trade. They have the two largest ports in Europe, the port of Rotterdam and the port of Antwerp. So there is action both on a national level in these countries, but also on a European level. The EU just a couple of months ago put out a roadmap, a new action plan to how they tackle organized crime related to drug trafficking. They are, of course, focusing still on ports. There's a lot of efforts to stop not just drugs coming in, but also chemicals coming in. These are the chemicals that would be used to make synthetic drugs. And then also there is discussions with countries where these chemicals come from. This is something that came up when we spoke to the drugs commissioner for Belgium. She is in charge of and coordinating the policy response within Belgium to organized crime related to drugs. They want to try and stop these drugs and these chemicals coming in that criminals use to manufacture drugs.
Max, thanks very much. Thanks for bringing us the story. Bloomberg's Max Ramsey in Brussels. We'll be back with more on the markets shortly. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, You can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Justice. So this COP is not only about deciding that we are going to gather renewable. This COP is also about deciding that we are walking the path of climate justice together. And we would like to thank everybody who made this possible because we united in diversity, especially in those times where some people, and especially children, might question if multilateralism still works. We have showed that we can work together if we unite. Thank you very much.
Okay, that was the German Foreign Minister, Annalena Baerbock, talking about the need for justice when it comes to this climate deal at and in Dubai at COP28. So hearing there from Germany's Foreign Minister on her reaction to this deal after, of course, days of negotiations. Let's get back to what's happening in the markets, though, and bring in Venram from our M Live team. It is, of course, Fed Day. We're counting down to that decision from the Federal Reserve and then, of course, the press conference from the Fed Chair, Jay Powell. And Ven, you've done some analysis on this and you've written it up beautifully in terms of the different potential outcomes as we look to the dot plot and how much pushback we could get in terms of market pricing. Run us through some of the key things that you're going to be looking for.
Absolutely, Tom. Lots of talk here in Dubai about climate change, but for the Fed, there is not much of a climate change from September, because if you look at the economy, it's doing pretty well. And we heard about core inflation yesterday coming in at 4%, pretty sticky numbers there. So the Fed is unlikely to say, you know what, the market's price, the markets are getting it right. 100 and 125 basis points of rate cuts through 2024 look good. They're not going to say that. They're going to push back on that notion. What does that mean? It means that they sanctify 50 basis points of rate cuts for 2024. That will take the median of the dot plot to 4.9%. And that's the big takeaway from that analysis, Tom.
Okay, and now you've had a little bit of time to digest the UK data. An hour and 55 minutes ago, we got that then. We talked about it then. But what does it mean to you now, do you think, the fact that we got that weaker than expected GDP print?
It kind of allows the market to front run what may come from the Bank of England later next year. But the question is, the Bank of England is caught between a rock and a hard place. The economy is losing momentum. There is no question about it. And we saw evidence of those numbers from the October GDP. But what is not looking good for the BOE's optics is inflation. You've got headline inflation around 4%, core inflation around 5%, services inflation around 6%. Those are hardly numbers that call for a rate cut. So the BOE is likely to push back on the notion of rate cuts tomorrow.
Okay, Ven. Yeah, absolutely. So hence a lot of questions about when we get those cuts next year. Venram, thank you so much from our Markets Live team. You can get up-to-date analysis from Ven and the team. MLIV Go is the function to use on the terminal. Coming up on The Pulse, Francine Lacroix will be speaking to Tal Cohen, co-president to NASDAQ, and she sits down with the Nestle CEO, Mark Schneider. All of that coming up shortly. This is Bloomberg.
the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Markets await the Fed's final decision of the year. It's expected to hold for a third straight meeting while pushing back on speculation on when rate cuts will begin. Then the UK economy shrinks more than expected in October. That sets the stage for another quarter of stagnation that's forecast to linger through next year. Plus, COP28 breaks new ground. The climate talks in Dubai end with the first global commitment to transition away from fossil fuels. And, of course, the two big interviews of the day. We have two great guests coming up on the program. I'm looking forward to speaking to Mark Schneider, Nestle Chief Executive, also for an exclusive conversation, Tal Cohen, NASDAQ Co-President. That's in about 10 minutes, and then at 9:30. So a lot going on, not only when it comes to big guests on the Pulse, but also what the market is looking at. So let's get straight to European markets map to have an indication of what treasuries are doing and how that filters through to what some of these equities are telling us. Now, if you look at European equities, we're seeing small moves. Again, investors really awaiting for the Fed's latest decision this year. We did have some recent data in the U.S., and that's been reinforcing speculation that policymakers will be in no rush to actually claim victory against inflation just yet. Now, I'm looking at the FTSE. It's gaining some 0.4%. CAC 40 also similar gains across the board. The other things that we're watching out for, and I do think I saw a pound chart, so I think we'll get that up for you, but a lot of focus will be on the UK economy and the fact that we could look at stagnation going forward. So inflation's coming down, but with it also GDP forecasts. That could be a bit tricky for the Bank of England as we get into 2024. You can see sterling 125.28. So investors betting that the Fed will hold interest rates when it wraps up its final meeting of the year later today. Much of the focus will be on what the central bank says about any policy easing next year. Now, for more on all of this, we're joined by Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management. Kim, thank you for joining us. I mean, there's a lot going on. It's all about inflation. It's all about the Fed. And it's all about whether policymakers feel comfortable to start talking about cuts. It doesn't feel like that moment in time.
Yeah, I think it's a little early for that. So today, the focus is going to be on the dot plot for the Fed, whether they show us 2 or 3 cuts for next year. It's a close call. It doesn't take too many participants to shift to that third cut. But we think probably they might try to stick to 2 just to end the year on a more broadly balanced tone rather than encourage further easing in financial conditions. And then, like you said, it's up to Powell how much he's going to push against that market pricing. I think he's going to want to be pretty balanced as well and stick to that message that we heard from him earlier, which is growing confidence in disinflation, but not quite there yet. It's still premature to talk about rate cuts.
I mean, Kim, the only thing that matters, I think, which maybe we don't talk about enough, is when we get cuts, if we get cuts next year, which is quite likely, is it for the right or the wrong reason? So the right reason is inflation comes down and you kind of track it with the inflation rate, rate cuts. But for the bad reason is that we could be looking at recession, potentially we could be already in one. So are you optimistic about the U.S. economy?
It's a good question. I think right now we're looking at the data. The labour market just isn't weakening fast enough to have that recession call come to fruition in the next few months. The payroll data that we saw, it's still around 200K on a 3-month moving average. The break-even rate there's more like 100 to 120. So to move into that recession narrative, you're going to have to see faster weakening in the labour market data.
So what does that mean for treasuries? I mean, overall, fixed income is kind of the place to be.
Yes, it's a good year, 2024 for bonds. I think taking one step back, up until very recently, the big question for the market was how high will we go? And that was a more difficult environment for bonds. Right now, the big question is when will they cut? And that's a much more conducive environment for bonds. So we think, maybe you get some retracement this week if central banks don't give us enough of a dovish impetus, and then the bond market hits a wall of supply in January. But bigger picture, there's still a lot more that the market can price, even if the Fed doesn't start as early as much to where they can eventually get to.
So, Kim, what do you think the market is mispricing right now? And again, there's a belief that we have cuts, but policymakers keep on saying, look, they're going to stay higher for longer. So maybe the market is overpricing too many cuts or too quickly.
Yeah, I think the risk from where the market is with about a 50% probability of the Fed cutting in March is that a still pretty healthy labour market pushes that out further in the year, despite the fact that we're going to get better news on disinflation.
The UK, the UK is also a case in point of, what the hell do they do, to use a technical term, given that inflation's coming down, but actually the economy is weakening.
Yeah, I think the Bank of England's in one of the trickiest spots. It's really hard. Like we had the weaker GDP data. Maybe that was influenced a bit by one of the wettest Octobers on record. And then we had the wage growth earlier this week, which was softer. But I think we need to be cognizant of the headwinds to inflation that the UK is still going to see going into next year. We've got one of the most prominent indexation issues, which will bias inflation up, or at least keep it stickier than other countries at the turn of the fiscal year. You've got the national living wage, 10% rise that's going to feed through to the wage data next year as well. And then it's the uncertainty about where the labour market's actually at, data quality issues, and also fiscal versus monetary policy. Are they still going for the same objective? So difficult point for the Bank of England. I think it's too early for them to remove their conditional tightening bias.
Yeah, and I guess, again, I don't know whether, Christmas spending makes a difference to understanding what the labour market could look like next year. Are there indicators, where you don't have to wait mid of next year to have an idea of what kind of economy we'll be left with?
Yeah, the Purchasing Manager Index, which is the leading indicator for business sentiment, will be a close one to watch. I think 2 months ago in the UK, that was looking really soft, and maybe the economy was starting to roll over. But in the last 2 months, that's really picked up and kind of unwound almost all of that weakness. So that's the one that we're going to be watching going forward.
What does that mean for gilts? So when you look at, sterling and gilts, is there anything, do you trade it or look at it compared to, for example, European bonds such as like BTPs or German bonds?
Yeah, I think the cross-country call's a bit hard at the moment. It almost feels like we're at like a really good buffet. You've got so many options and spoiled for choice. But I think the picture in Europe is maybe clearer in terms of the softer growth, softer inflation. The biggest news we probably got in the last few weeks was from Europe, just that speed of disinflation, which the ECB is going to have to address tomorrow.
And then I think we have finally some agreement on the German budget. Was it something that you were looking at to kind of decide, what that meant for German bonds?
Near term, not the biggest driver. It's still going to be what Lagarde pushes back on market pricing tomorrow. It was interesting that Schnabel had a big shift on the latest disinflation data, going from the last mile of disinflation being the hardest to ruling out further rate hikes. So how much is Lagarde going to echo that same message or stay more neutral, I think is going to be the bigger impetus for bonds.
Kim, thank you so much for joining us today. Kim Crawford, our Global Rates Portfolio Manager at JP Morgan Asset Management. Now, coming up, the co-president of NASDAQ on the exchange's biggest ever deal. We'll discuss the IPO market heading into 2024. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
So NASDAQ has recently finished its biggest ever acquisition, adding software provider Adenza for $10.5 billion. Now, it's part of a strategic move by the U.S. tech exchange to help it transform from a trading and markets firm into financial technology. So let's discuss all of this with NASDAQ co-president Tal Cohen. Tal, great to see you, and thank you. You're in London, which is extremely exciting. So tell me about this big acquisition. How's it going?
Yeah, so thank you for having me this morning. This is a transformational opportunity for NASDAQ as we can become and solidify our place as a strategic partner to our clients, given the capabilities we're bringing on with Adenza, where we're going to be a market leader in helping our clients solve their toughest operational challenges across risk, regulation, and trade management, and also puts us one step closer to the ambition that we have to be the trusted fabric of the world's financial markets.
So talk to me a little bit concretely. Have you folded in, for example, the teams and technology into NASDAQ, or will that take a little bit longer?
So we closed the transaction on November 1st.
Yep.
We hit the ground running. We're going through integration right now, and we are starting to fold the teams together, integrate, and make sure that we're driving alignment. And we made an announcement about what that team's going to look like.
Yeah.
And now we're talking to customers about what we can do for them.
So when do you see the benefits of the acquisition? When do you start actually seeing returns?
Oh, we're already starting to see a few of the benefits. Clients are already approaching us about what more we can do for them on the risk, the reg tech, and trade management side, because we complement each other so well.
So how will you use AI to actually transform the business? Again, do you have any concrete cases that would explain to our viewers how it will transform your business, but also what clients can do?
Yeah, we've made investments over the last few years that have really helped us unleash the power of AI. We've embraced our data management platform. We've embraced the cloud. We have a really strong posture on information security, and we put a governance structure in place to make sure that we do it safely and responsibly. And now we have over 20 products that are either powered or enabled by AI across all of our different markets. One great example is we have an AI-assisted fraud detections where human analysts can now use Gen AI and a large language model to really automate all manual tasks so they can focus on higher value activity and truncate the time for each investigation. It's a great example of how we're using AI to fight financial crime.
So, Tal, NASDAQ also, I think at some point, planned to launch a crypto custody business, but you abandoned the strategy. Are you completely out of it, or is it something that could come back?
We've been really disciplined from the start in terms of capital allocation into crypto and digital assets. We have not made any major acquisitions. That custody platform that you just talked about, we're still going to launch it, but we're going to launch it as a technology service. So we're going to have an institutional grade end-to-end technology platform that we hope powers not only digital assets, but markets like carbon, where we can increase adoption and maturation of those markets through this technology.
But is there something that needs to happen with regulation for you, I guess, to become much bigger in the digital asset marketplace?
Well, regulation is still the big unlock, and there's a few unlocks there. Regulation, clarity in the U.S. in particular, but also institutional adoption. It's been a little slower over the last year and a half as interest has waned because of some of the events in crypto and digital. But we're using the DLT and the blockchain technology to power other markets, like I said, like carbon. We have an opportunity to do that with tokenization on hard assets. We just announced a deal with Chile as well. Okay. So that's been our focus.
Tal, I know the SEC has also put some market restructuring proposals in place, or market structure proposals in place. If you look at the regulatory space, like, what worries you the most?
The amount of regulation, the pace and intensity of regulation. Right now, you have it both on the banking side, which folks aren't appreciating. You have liquidity and capital rules from Basel III Endgame, Basel IV. And then on the capital market side, you have market reforms, and you have this move to T+1 in the U.S. markets. So I think the combination of all that is putting a lot of pressure on banks, and it's increasing the operational complexity of running these large institutions.
So it's really the amount of regulation. It's not one specific. Are you expecting more regulation to come in 2024?
Yeah, and it's really the confluence of all that regulation happening at the same time, and the banks trying to resource that and understand how they navigate that. And I think this is going to be an ongoing thing. We just did a survey of our clients, banks, brokers, and market operators. Their number one concern, 64% of the respondents said, it is regulation.
I also want to talk to you about IPOs, which I know is a small part, but actually if you're sitting in London, you managed to grab a lot of the companies that maybe politicians and policymakers would like to list here. We also understand that there's going to be more of these listed companies going to the US. What do you think is driving that?
Well, let's talk about Europe for a second and what's happening in Europe. It's a great question. It's not homogeneous in Europe because our Nordic franchise in Sweden, we have a great SME listings market. It's first class because of the retail participation and the pensions that are driving it and the government that's supporting it. But more broadly in Europe, I think you're facing structural issues around tax regime, onerous regulation, a lot of fragmentation and complexity. And then on the NASDAQ side, and we love our listings franchise, by the way, we have a great listings franchise, deep pool of liquidity. You have the NASDAQ 100 family of indices. We are really taking a leadership position in ESG, helping issuers understand that. So we have this great day one experience, and then we have all these other corporate solutions we provide.
So what do ESG issuers need more of? I mean, I guess clarity, possibly a carbon market. I don't know. I mean, why is it taking so long?
And so on ESG and issuers, they're just trying to understand the disclosure and the reporting needs. Yeah. It's really difficult if you're an issuer to understand what investors are looking for. So we're providing advisory services, trying to explain to them, this is what issuers are looking for, this is where governments are going. And governments aren't really coordinated on their view on ESG, which is making it even more difficult on issuers.
So as we go forward, listings will be how much of your overall business?
Listing is just foundational. Yeah. It drives a lot of activity on the exchange side, as you know, and we're going to continue to invest in our listings franchise. It's a premier franchise. We just actually renovated our market site location, so that tells you a little bit of how we think about our listings franchise. We won, as you noted, ARM this year, CART this year. Yeah, so some of those, that's right. Some of those issuers are looking at the U.S. markets, the liquidity that we have, the investor base we have, and the health of the capital markets there.
Do you field angry calls from UK politicians?
Not yet. Not yet. I'm hoping not to get them, but we want to also help Europe. So to be really clear, we have a big franchise in Europe. We're willing to take that call and talk to them about how we can help in Europe.
What do you worry about the most in 2024? You have a lot of exciting things on your plate.
Yeah, so there's a confluence of events that I'm keeping an eye on. One is we're always thinking about cybersecurity. As we have two wars going on, we have to make sure that we're running our markets, which is critical infrastructure, and make sure they're well-functioning and resilient. So that's one. Two is we want to put AI to work responsibly and safely. So there's a lot of effort to make sure that we're doing that. And then third is, we got the Fed in focus. We got to see what kind of uncertainty and volatility comes. We have a couple of elections that are noteworthy in 2024. So we're just preparing the team to make sure that we're there for markets when they need us most.
I like that. A couple of elections. Probably the understatement of the year. You're so British. Thank you so much for joining us.
Thanks for having me.
The NASDAQ co-president, Tal Cohen, with the very latest on, everything really, the acquisition and some of the pitfalls that he sees ahead. Coming up, the COP28 climate talks in Dubai have ended in a deal on shifting away from fossil fuels for the first time ever. Yes, we're live in Dubai as the summit comes to a close. This is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Now to COP28, where climate talks have ended in a deal. For the first time ever, the agreement commits to a global transition away from all fossil fuels.
We have given it a robust action plan to keep 1.5 within reach. It is built on common ground. It is strengthened by full inclusivity, and it is reinforced by collaboration. It is an enhanced, balanced, but make no mistake, historic package to accelerate climate action. It is the UAE consensus.
Well, joining us now is Bloomberg's Laura Milan, live from COP28 in Dubai. So, Laura, how does this agreement actually balance U.S. and European needs against those that oppose any fossil fuel targets?
So it's fair to say that this agreement doesn't satisfy 100% everyone, and that's usually the recipe for a balanced deal. That said, the mood in the room is quite positive right now. We have seen the EU and the US highlight that the deal doesn't go far enough in phasing out all fossil fuels. The language is a bit softer than that. They had to give up on some of that ambition. But on the other side, we have just heard a few minutes ago Saudi Arabia representatives say they are quite happy with the agreement. Some of the things in there that make the Saudis and other fossil fuel producing countries happy is the mention of carbon capture technology as a way to reduce emissions, as a strategy to reduce emissions, and also the idea that not all countries have the same responsibility to phase out or to reduce the use of fossil fuels at the same speed.
So what does this mean in real terms? How does this change the field of play, for example, for investors, but also consumers?
Some of the analysts that we have talked to highlight that this is actually one of the most concrete deals that the COP process has approved so far. We have real-world practical things in there, like a commitment to triple renewable energy by the end of this decade, a commitment to double energy efficiency, and we also have mentions to electric vehicles and other technologies. So after the deal, now that the deal is approved, countries will have to go back to the drawing board and design ways to reduce emissions that include these very specific technologies.
Laura, thank you so much. Laura Melander, live from COP28 in Dubai. Now, also making news, governments across Southeast Asia are bringing back measures to limit a resurgence of respiratory diseases as Singapore, Malaysia, and Indonesia all report an increase in COVID cases. The measures include temperature scanners at airports and mask wearing. The U.S. CDC has warned of the transmissibility of COVID variant named JN1, a strain that is accounting for about 60% of current cases in Singapore. Now, Bloomberg has also learned that SpaceX is to sell insider shares at $97 apiece in a tender offer, a price increase boosting the value of the space and satellite company closer to $180 billion. Now, the offer at the world's second most valuable, closely held startup is set to be in the range of $500 to $750 million. The rising valuation is indicative of strong investor demand for the dominant space transportation company. Now, Bloomberg understands that X, formerly known as Twitter, is on track to bring in roughly $2.5 billion in advertising revenue in 2023. Last year saw $1 billion coming in per quarter from advertising. The first 3 quarters this year brought just about $600 million in each quarter, while ad sales currently make up 70 to 75% of X's total revenue. Coming up, the exclusive interview of the day will be joined by Mark Schneider. The Nestle chief executive will discuss the challenges, but also the opportunities in the food and beverage industry. We'll talk about the outlook for next year. That conversation is up next, and this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Now, markets await the Fed's final decision of the year. It's expected to hold for a third straight meeting, while pushing back on speculation on when rate cuts will begin. The UK economy shrinks more than expected in October, setting the stage for another quarter of stagnation that's forecast to linger through next year. Plus, COP28 breaks new ground. The climate talks in Dubai end up with the first global commitment to transition away from fossil fuels. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, from cost pressures to a slowing world economy, the impact of climate change to new lifestyle trends, the food and beverage industry is really facing a number of headwinds. There are challenges that the world's biggest food and beverage producer, Nestlé, is also grappling with. Now, shares down about 6% over the past 3 months. There are also worries from investors that a new class of weight loss drugs could threaten profit. On the positives, there's innovation and, I guess, things to sell all over the world. Well, joining us now for an exclusive conversation is Mark Schneider, the chief executive of Nestlé. Mark, thank you so much, and also thank you for coming in our London studio. I mean, I could speak to you about 3 hours because you really have a microcosm at your hands of trying to understand what the world economy is doing, what people are spending on, what they don't. First of all, how's inflation going?
Well, look, we're coming out of a pretty historic 2-year inflation spike. When you look back for historic precedents, it's not till the 1970s, so literally a 50-year event. And the spiking is over, but you still see somewhat elevated inflation levels. It's too early to call deflation. And so after these 2 years, it's understandable that consumers have some trouble making ends meet. Yeah. There's caution out there. You also see that central banks have done what they're supposed to do, and that is fight inflation. And so that is now making its way into the real economy. You see mortgage rates going up, you see leases and rents going up, and so all of that adds up to a good deal of consumer caution.
But overall, Mark, how has Nestlé actually changed under your watch? I don't know whether there's been more or less. For example, ad spend. I know you've readjusted also the focuses and the key markets you want to be in.
Yeah. So I think the key item over the last 5-6 years internally was cranking up the rate of innovation and clearly making sure that for an industry-leading R&D budget, we're getting a steady flow of new and exciting products, because that is ultimately what drives mix and what drives revenue growth from a real internal growth point of view. And then on the external side, we've done a lot of portfolio rotation, about 22% over 6 years. Deal volume of about 50 billion with good acquisition outcomes, but we're remarkably also walking away from potentially 50 billion worth of deals when prices seem to be too high. So good amount of deal discipline at the same time.
How much transformational deals do you think you'll do in the next 2 to 3 years? I know one of the big questions is, for example, margins in water, which is also, they're lower than the rest of the group, and they're not that sustainable or climate friendly. Is that something that you'd get rid of?
Yeah. So we made it clear that the bolus of some of that portfolio rotation is done, but clearly on a large book of business that's approximating 100 billion Swiss francs, you constantly have some portfolio rotation. You're trading into very promising areas. And when you see longer-term limitations to a category, then you have to ask yourself the question, are you the best owner? Is it the best fit? And so specifically, I have no announcements to make today, but clearly, that process of evaluating opportunities either to grow or to divest will continue.
So I know geographically, for example, you've said in the past that you want to be very present in India.
Yeah.
Or can we expect something big in India because of consumer demands and actually the wealth of citizens is growing?
So India is a super exciting market. We even held a board meeting there last year to see on the ground all the dynamism. We're super impressed with the move towards digital. So clearly that to me is the biggest change from pre-COVID years to post-COVID years, how that economy has fully digitalized and taking all the benefits that come from that. So clearly we're growing there very consistently with above par growth rates. Would be very happy to build on that with additional acquisitions. But obviously we also have to look out for value and have to look out for valuations that make sense for us.
I mean, what do valuations look like right now? Again, because of inflation, I don't know whether it means that maybe in the next 6 to 8 months it's easier to find good deals, or whether it just makes it tricky because of all of the unknowns.
So generally from their peak in late 21, valuations have come down somewhat, but you see that some people, especially those who don't need cash immediately, are still holding out, and there's a hope that maybe the Goldilocks years will return. I think it takes a bit more time for the newer realism to sink in, and what you saw us do is act with quite a bit of caution here when it comes to deal-making activity in 22 and 23, and I think that was the right call.
Yeah, I mean, again, there's quite a lot of volatility. We touched on inflation. There's political upheaval. Like, overall, what do you worry about the most?
So clearly, it's going to be staying a very turbulent environment. We'll need to see how the economy continues and what that means for consumer sentiment, especially during the winter. And then also between the business strategies and geopolitical risks to be sure that we navigate in a way that we can live up to what we want, and that is stable, dependable growth.
So what are you optimistic about? Again, I don't know whether the holiday season in certainly the Northern Hemisphere is a good test of actually consumer robustness going into 2024.
Yeah. So what I'm most excited about is the fact that we have a portfolio now after a lot of adjustments that's geared for very dependable, successful growth. We've had lots of gyrations here due to COVID and in-home consumption, out-of-home consumption. And so looking beyond the short-term consumer caution, I think it's more important to see 24, 25, looking ahead, what are the underlying strengths here that this portfolio has to offer?
But again, so given the numbers that we have now, so what kind of trends will you see going forward? Now you have the health business, which is vitamins, and I don't know whether that takes a hit because of recession or that stays strong as people maybe go out less and take more care of themselves. Yeah. You also have a huge pet business.
Yeah. So pet continues to just steamroll ahead. So what we've seen there is a step up in pet adoption during the COVID years. It is not growing at double digit maybe anymore, but still, nonetheless, it's one of our highest growing categories, and it had 3 stellar years behind it and will continue to be one of our hallmark categories. On vitamins, minerals, and supplements, we did have a bit of a COVID or post-COVID hangover in 22. As you can imagine, during the COVID time, people were trying to boost their immune systems to the hilt, and now that had moderated somewhat. Yeah. That came to an end spring, summer, and then we saw demand coming up again. So there, going forward, we also expect very successful mid to high single-digit rates. Short term, we are marred by an integration issue that we called out to our investors in October. But once that is fixed, starting from 24, we should see that underlying growth coming through.
So were you able to actually increase prices and have higher margins? I imagine pet food is one of them, as people are willing to spend more for their pets.
Yeah. So we had to increase prices to reflect inflation on our input costs. As you know, it's also important for us to pay fair prices to our suppliers and the farmers in particular. But as you also know, our gross margin reduced a little bit because we were very much tuned into this idea of fair pricing and being sure that we're not fueling inflation. So whatever increases you're seeing in pet food are more due to meaningful innovation. So basically premiumizing the products. And this is one of the long-term growth drivers in the pet food industry.
Right. How much do you spend on innovation? Does the budget just keep on growing every year as you need to make sure that you're cutting edge at all times? Okay.
Yeah. So innovation is a key growth driver, and we have an industry-leading budget there of about 1.7 billion Swiss francs. Okay. And more importantly, making sure that translates then into short cycle times from concept to shelf, and a steady flow in each category. That's important. I spent a lot of time with our head of R&D sampling products personally, spending time with the team, because clearly I want to be sure that they understand, everyone understands in their group, that their function is vital to ensuring future growth.
Okay, what's the most exciting thing you've tried? Or is that secret? The prototype.
The prototyping is always secret, but obviously we have very exciting developments underway when it comes to plant-based food. Coffee is a constant source of innovation, so there you see a never-ending expanding universe when it comes to new varieties and new trends. And then, as you mentioned, pet food is the other big one, where clearly consumers are yearning for premiumization, and we're happy to dish it up.
So, Mark, when it comes to plant-based food, this has been the trend for quite some time. I guess eating also less sugar, less, just being more healthy in general.
Yes.
Does that go up on a trend or up and down?
Look, I think short term you have ripples and you have fluctuations, especially now when it comes to purchasing power, when it comes to some of the COVID limitations and the inflation spike. Longer term, the trend towards more plant-based nutrition is unbroken, and I would not define it narrowly as a look-alike burger or a piece of chicken or something. It is more about dialing up plant-based proteins as a source of your nutrition. And there, across the full spectrum, at every price point in every location in the world, we have very exciting developments underway.
Okay, so interesting. What's the one thing you can't live without, Mark, out of all of your products?
That's an easy one. It's an espresso. Clearly, I've been a 20-year customer and looking forward to the next 20 years.
Yeah, I think I have an espresso actually behind.
Behind you.
I'm like, 50 human, 50 coffee, so I could probably agree with that. We'll continue the conversation with Mark Schneider, the Nestle Chief Executive. He stays with us, and this is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is A Pulse, and I'm Francine Lacqua here in London, powered, you see, by coffee espresso there. Mark Schneider, the Nestle Chief Executive, is still with us for an exclusive conversation. Mark, we're joking around that we're both powered by coffee in general. You Nestle coffee, me anything really. Talk to me a little bit about, we're talking about premium brands, about the fact that I guess you have to be careful at, making sure that you don't go up too much in prices because people can't afford it, but also this trend towards optimization and premiumization. Where do you see the strongest markets region by region?
So look, we're committed to brands at all price points and levels of affordability. So it's not like premiumization is exclusively taking over. But yes, over a 10, 15-year period, we have been quite successful in premiumizing some of our brands where consumers were open to that. And we see lots of runway for that going forward. Oh. Clearly, the most advanced markets in the U.S., in Western Europe, and also in Asia are the ones that tend to be the front runners here. And then you see that around the globe, everyone is getting very interested. And of course, these days, through digital media, whatever is cool out in the West Coast or New York gets emulated elsewhere really, really fast.
But in terms of numbers or consumption, do you see a bit of softness in Europe, Central Europe, but also the UK?
I think the premium side usually holds up quite well. There's a bit of trading down. It's more like at the mid-range of midpoint of the price range, where you see now some people more trading down to either cheaper brands or the private label, or also there's a reluctance to consume in the first place. So we saw, for example, in the U.S. With the running out of some of the SNAP food benefits in Q2 and Q3, that led to some hesitance. Now, it's a one-time thing. It'll lap out of the system next summer, but, those are some of the trends we're watching.
But so do you think that people tend to buy less but higher quality when interest rates go up and therefore they feel a little bit squeezed?
Well, that may be one trend. And look, that may be a good thing because generally our whole strategy is towards higher value, either nutritional value or premiumization, and be prepared for lower calorie future. So actually that's something that's right up and backed up by our nutrition, health, and wellness strategy.
Mark, one of your main competitors was in a spot of trouble this week because of labeling of ESG products on recycling that, some of the regulators here was maybe not the case. How do you deal with potential greenwashing in your industry and at Nestle?
Yeah. So I think we've made some very early efforts to make sure we live up to our vision, and that is to have none of our packaging end up as landfill or littering out there. And we're making very, very steady progress when it comes to reducing the amount of virgin plastics and reducing the size of packaging in the first place, and also advancing design for recycling. These are very challenging technologies. The devil is in the detail, literally, especially in our industry, because for food-grade packaging, you're so much more limited on what you can do. And obviously, some things work, others don't. We try to communicate as truthfully as we can. We're super transparent. We're publishing lots of data points around our progress around this, and want to be sure that consumers do have good sources of information coming right from our company.
But how difficult, again, how difficult to get a handle on the supply chain? You have very long supply chains,
yes.
And so something can always go wrong, or there could be a mislabeling or something that you're not quite aware happening.
Yeah, and look, this is a developing area, and I think what the public should take away is we're really sincere in our efforts here, and we've done this now for a number of years, and we're having good progress to report. Occasionally, some things don't work as fast as originally anticipated, and we're quite open about that. And occasionally, look, especially in a fluid situation with long and complicated supply chains, something may sort of change, and then obviously it's important that people trust us and that they trust us being transparent about this and communicating the right things.
Right. I know there's always been quite a lot of speculation on what you do with the ice cream business or some other things that are IPO'd or spun off. Or can we expect something of that magnitude in the next 12 months?
So clearly we've had fantastic success with our ice cream joint venture called Froneri, where we partnered with a private equity firm, and we've taken this now to one of the leading ice cream companies in the world, and very excited about it developing going forward. At this point, no announcement to make, but couldn't be happier with how this develops.
Yeah, given the trends that we've seen over the last, 4 to 5 years, which we've talked about, which is, more nutrition, watching what you eat, more plant-based, are tastes changing? How much focus do you put on trying to understand just physically how human behavior and human tastes will be in 3-4 years?
Well, obviously, this is a core area of our research. There's some general trends. There's also medical insights. And then, of course, there's lots of regional preferences. But one of the medical ones these days, of course, is the advent of GLP-1 drugs and what that means. Here, I see it's not so much a threat for us. It's more like a full-blown vindication of the strategy that we've been pursuing very patiently over the years. Take our high-growth categories that are not impacted by GLP-1, pet care, coffee, and our Nestle Health Science business. That used to be 30% of our business in 2016. It is now about 50% of our business. So clearly, this is where portfolio rotation prepared us for this lower-calorie, higher-value future that we've been pursuing. So it's not impacting us.
I know a couple of years ago we talked a lot about some of the local players, for example, in India and others, like local brands that became massive that people preferred in certain emerging markets. Is that still the case? Again, is this one of a threat maybe that you're looking at?
Yeah. So we're seeing very successful local brands. We're seeing very successful global brands. And to me, it's not so much about local versus global. It's about strong versus weak. And so clearly, if a local brand is meaningful, we'll drive it. We have a stable of about 2,000 brands around the world. If a brand is global, obviously, that is a core asset. We have more than 30 billionaire brands, and those are growing above par.
Mark, thank you so much. What a fun conversation. I could talk to you for another 3 hours.
Same
just talking
here,
about
same
food and health. Mark Schneider, they're the Nestle Chief Executive Officer. Now, coming up, Argentina devalues the peso by over 50% as newly sworn-in President Javier Milei launches his economic shock therapy program. So we'll have plenty more on that next. And this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company. People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Will the ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimate, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
Now let's bring you some of the stories hitting the terminal this morning. And Germany's ruling coalition has sealed an agreement on a revised 2024 budget. The revised plan hopes to settle the constitutional chaos triggered by last month's court's judgment limiting the use of off-budget funds. Now the Chancellor Olaf Scholz, Economy Minister Robert Habeck, and the Finance Minister Christian Lindner will brief reporters on the details of the deal at 11 a.m. UK time. The United Nations General Assembly has voted overwhelmingly to demand a ceasefire in the Gaza Strip. It marks a shift in sentiment, with U.S. President Joe Biden warning that the Israeli Prime Minister Benjamin Netanyahu risks losing global support unless he changes his views on a two-state solution. And Hungary says it is prepared to lift its veto on a massive EU funding proposal for Kyiv in return for $30 billion in financing. Now, the EU has been withholding the funds from Budapest since last year as a result of democratic backsliding. Meanwhile, Volodymyr Zelensky has left Washington with no clear commitment from the U.S. that it will maintain financial support for Ukraine. Congress does not look likely to approve the $61 billion of aid Ukraine requested, but President Joe Biden vowed the U.S. would come through. And Argentina has devalued the peso by 54%, overhauling its crawling peg, and announced massive spending cuts. Now, the newly sworn-in President Javier Milei has promised to rescue the nation's economy with a shock therapy program. For more on this, we're joined by Ziad Daoud. He is Bloomberg's chief emerging markets economist. Ziad, so good to speak to you. So can you tell us a little bit more about these recent moves and actually how the market reacted to them?
So Argentina moved on two dimensions, Francine. It moved on the currency. It devalued the currency by 54%. The current official rate is still below the parallel rate, so they also said that the currency would weaken by 2% a month. And they also moved on the fiscal side. So on the fiscal side, Argentina has slashed spending, is cutting spending to pensions, it's cutting subsidies, it's halving the number of ministries, and is planning to increase the tax intake. So overall, Argentina is trying to fix its foreign exchange market, is trying to reduce its budget deficit, which is the root of all of its problems. But these two measures will come at a cost, and the cost is on growth. So our team expects Argentina to contract next year, and that's on the back of an expected contraction this year. So 2 years of negative growth in Argentina, that's the cost of fixing the foreign exchange market and fixing the budget deficit.
So, Ziad, President Milei has also pledged more drastic steps in his election campaign, dollarizing the economy, abolishing the central bank. I mean, are these coming next, or is that wishful thinking on his part?
Not imminently, Francine. So Argentina doesn't have enough dollars to dollarize the economy, which is basically replacing all pesos in circulation with dollars. Our economist, Adriano De Pita, estimates that if that happens, if Argentina were to do that today, then basically you're going to have a massive reduction in the value of the peso. And basically, if you think contraction and recession is bad, imminent dollarization would basically cause a depression in Argentina. But we don't think that the idea is completely off the shelf. We think that the president is basically postponing rather than abandoning the idea. He thinks that dollarization would fix Argentina's inflation problem once and for all. He thinks it will limit the central bank's ability to fund the government's budget deficit. And he thinks that would basically end Argentina's budget problems once and for all. So it's not imminently, but it's not completely off the table yet.
Ziad, thank you so much. As always, Ziad Dawood there, Bloomberg's chief emerging markets economist. And, of course, Europe's biggest money manager, Amundi, is also counting on Javier Milei's shock therapy and Donald Trump's return to pay off big for bond investors in Ukraine and Argentina in a bet that right-wing populism will actually determine the most compelling stories in emerging markets next year. So we'll have a full, of course, roundup of some of these top news shortly. This is Bloomberg. From a mining company, which frankly is dirty, it's big, now you want to reposition the company into green energy powerhouse. Are you a walking contradiction, or what did you learn along the way?
Well, in the early days, it was considered completely impossible for anyone. Doesn't matter if you're a huge company, like back then it was Anglo-American tried to break into the iron ore industry, and they spectacularly failed, even though that back then they were the largest mining company in the world. Now, for an upstart, a tiny little company with next to no cash at bank, no ground, no anything, for them to announce that they were going to break into the iron ore industry, the global seaborne iron industry, the most protected, viciously protected resources industry in the world, and then take them on head on, it was just considered impossible. It was just like a fairy tale. However, we stuck to the plan. We always tested each other by making sure that we were starting where we wanted to finish, which is as a major iron ore producer. And then we took all the steps back. We calculated what the steps would be, even though some of them seemed impossible. Now we have a strategy, and we've got to go flesh that strategy out and pursue it with single-minded focus.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Here comes the Fed. The central bank is set to hold rates steady after the latest CPI print reeled the rate cut bets. Shock therapy. Argentina devalues the peso and announces a massive round of spending cuts to revive the nation's troubled economy. And SpaceX's value soars to $180 billion, illustrating strong investor demand for a stake in the Elon Musk startup. A very good morning to you. We have a frenzy of central banks over the next 48 hours. And the bond markets, it's almost like they're saying contenders ready for a showdown. The next 48 hours will define the narrative for rates. They drop ever so slightly. Nobody choked on the 30-year bond auction last night. Yes, there is sticky core inflation in the United States of America at 4%. That's a problem for the rate cut doves. But what will the Fed message be? It's probably going to be around curb your enthusiasm. Can the dot plot alone achieve that? Will that fill or kill the 100 basis points of rate cuts for 2024? Yields drop there, yields drop in the UK as well. What you have in the UK is a stagnation nation. Growth drops in the United Kingdom at negative 0.3%. And that data really fuels the size and the scale of rate cuts in the UK. The market is now pricing 95 basis points of cuts in the UK as we see that negative GDP print. Stagnation nation, it's Danny's favorite phrase this morning. Oil drops this morning down to 0.1%. The Russians just keep on sending it out there. Keep on sending the supply on the boats. Exports are the highest since July, and we have a bearish contango. It's almost contenders and contango ready in these markets. It's a downward swoop all the way along in yields and oil. Ms. Berger, good morning.
Menace, I like stagnation nation because if it rhymes, it must be true. Those are the laws of economics. Anyway, over the past 24 hours, I mean, it's a story we've heard for a very long time. Data comes in a bit hotter than expected, and risk just doesn't care. Equity markets in the U.S. are at a 20-month high. The S&P 500 future session takes up again this morning. We're up 0.1%. Goldman, though, says that the quants, the CTAs, they are long, and regardless of the scenario over the next week, they will be selling. Of course, CTAs have a big diversity of models, so interesting that they can kind of put that all together. But nonetheless, that is what they say. NASDAQ futures, these keep climbing higher, too. We are now 1% away from an all-time high for this NASDAQ. If you look at the VIX yesterday, that fell to just around 12. That's its lowest level since pre-pandemic. There is still calm in these winter markets. Finally, the one market that isn't rallying, which again has been the case for this year, the CSI 300. China stocks fell in the session, closing down 1.7%. We had the Chinese economic meeting. There was no silver bullet stimulus, and because of that, no fresh catalyst to trade upwards on. So China stocks fall, led by property developers. Manis, the rest of this market, though, rallying. It's done this thing that, as John Authors had put it, the biggest problem at present is of the market's own making, and that is financial conditions. At the moment, let me show you the chart. They are the loosest since just before the Fed started its hiking cycle back in February of 2022. It wasn't that long ago, was it, that, Manis, we had all these policy speakers saying that, yeah, the market's doing the work for us. Now it's the opposite.
Oh, those FCONs, they're just light. But of course, it was 2020 when Powell said, we're not even thinking about raising rates. It took him a year to raise rates. How much could we dare him to come out with something as authoritative as that to try and re-grasp the narrative? Oh, those light FCONs. You do like it this morning. You're on fire this morning. Danny, let's talk about the...
Thanks. It's because I'm wearing red.
Good. The inflation data, it ticked up in November, as I said. It dented the hopes for the Fed. Rate cuts anytime soon. Our next guest weighs in on the report, writing the following. We see it as a red light against the Fed cuts here. That said, many areas of the bond markets and credit markets especially are still in panic buy mode for a mix of fundamental and technical reasons. FOMO, that you're not long enough duration. Alberto Gallo is with us, CIO and co-founder of Andromeda Capital Management. Alberto, great to get you in on Fed Day. So, here we are. You say we're in full panic mode, buy mode. Do you think that bonds trading at 419 is a sense of FOMO? Is that perhaps the biggest risk of all, that there's a pushback and that these bond markets and duration are mispriced? Good morning, good afternoon to Singapore.
Good morning, Manus.
So it's a lot about positioning. We started the fourth quarter with very short positioning, both in the rates market and the credit market. And following the October events and a dovish tilt by central banks, what we have seen is short covering and panic buying across investment grade, across high yield, and across rates. It's hard to say when this will end, but we are back to a very complacent market opportunity setup. So where investors in the rates market are pricing in a lot of cuts for next year, and the equity market is at a high and volatility is at a very low level. So it's a period where you want to step back. You want to be respectful of the fact that the market can keep going, especially in names where investors and banks are still short. But eventually central banks need to push back. Otherwise, they'll lose control.
Alberto, on that point, you mentioned the credit markets, and I happen to have that chart right for us. It's the junk bond spread, now at its tightest since April of 2022. When you look at that, and you look at this price to perfection, soft landing, many of cuts, is it enough to just say there will be less cuts in 2024 that could spoil the high yield party, or does it need to be something more dramatic?
Not only that, but we have 0.5 trillion in money on the sidelines in the private market. So the public market is at record tight, and there's people queuing to invest in the private market. So when a company has a problem, when a company cannot refinance, there's competition. There's like 2 or 3 different funds competing to lend to that high yield company, to that first bad apple that falls from the tree. So financial conditions, as you pointed out, are very loose. The market is doing the job of central bank easing, and there should be definitely less cuts next year than what's priced in the market. We started 1 year ago in January. We started with a lot of cuts priced, no hikes priced. We got a lot more hikes than the market was pricing for this year. We got a lot more tightening. And now we're back in a situation where the market is over optimistic with 5-6 cuts priced in the US and Europe. But especially in the US, we could see 1 or 2 cuts at most, and later in the year. And it's also about fiscal spending. So you've got fiscal spending, you've got inverted curves, you've got easy financial conditions, and a lot of money on the sidelines. So central banks can't afford here to just lose control of expectations and give in.
But then how do they re-grasp that narrative, Alberto? We're going to get the dot plot, we're going to get the economic summary of projections, etc. So that's a little bit of a show and tell. I used the quote from 2020. Powell said he wasn't thinking about raising rates, and it was 1 year before he did. Now, I'm not saying that that's necessarily what he's going to try and do today. But do you think that we need to readjust that it is not higher for shorter, it is higher for longer, and that the bond market has structurally not got that? It is mispricing that.
Well, there's a lot of reasons why inflation can stay higher, right? One of them is geopolitical risk, structural reasons, onshoring. We see a lot of onshoring in the US, and a general repricing of labor. There's just less labor available, both in the US and if you look at countries like the UK, which you rightly cited, stagflation nation, there's a lot of supply bottlenecks. It's a long debate about economies. It's almost philosophical. Is it supply? Is it demand? Supply bottlenecks have come down. Demand is still very strong. The US consumer keeps spending. So I think from now on, we got to have a look at demand. And there is a good chance that demand actually increases following the easing in financial conditions that we have seen so far.
Right.
So there's a chance which the market price is at 0 or near there that we have reflation next year.
Well, not to harp on this too much, Alberto, but I really like how Manus put it to start his question. You're talking about the data and that impacting the market, but can the Fed, can they jawbone this market at all to back away from the cuts? Or is it just we're going to have to wait for the data and whatever they say isn't going to change the narrative?
I mean, unfortunately, I don't think Chair Powell will say we're not even thinking about cutting. He should say that. He should say that, but I don't think he's going to say that at this meeting. He's going to probably push back, but in a softer way. And there's a hidden story here, which is the Bank of Japan. And one of the reasons why I think the ECB and the Fed have been very dovish on top of the low inflation data is that they've started to prepare the ground for the Bank of Japan to hike, which, as you remember, 1 year ago created a turmoil across bond markets. So I think that's why they are not pushing back as much. And the Bank of Japan should go in January, perhaps next week, but most likely in January. And I think that's why they fear that pushing back so aggressively would correlate treasuries and bonds to the JGBs. So I think that's what's keeping, and also they're waiting for data. But I think the BOJ is also a key event that they want to,
Yeah. Well, let me tell you, Alberto, on brief, the BOJ is definitely not a hidden risk. We've been talking a lot about it this week, so happy to get your thoughts on it, too. Alberto, thank you so much for joining us. Alberto Gallo there of Andromeda Capital Management. Manis, let's get some of the other stories that are trending on the terminal this morning. China's top leaders, including President Xi Jinping, vowed to make industrial policy their top economic priority next year. The leaders say China is facing weak expectations and are calling for development of strategic emerging sectors. But the measures are a letdown for investors who are hoping to see more forceful stimulus to boost growth.
X, formerly known as Twitter, is on track to bring in roughly $2.5 billion in advertising revenue for this year. That's a significant slump from prior years. Ad sales currently make up 70 to 75% of X's total revenue.
Walgreens is said to be reviving talks on a potential exit from Boots. The UK pharmacy chain could be valued at £7 billion, and a London IPO may also be one of the possibilities. Manis.
Coming up, Argentina in crisis management mode. The country is rolling out measures to stop the economy from going deeper into crisis. That's next. Danny.
And later, since Alberto endorsed Stagnation Nation, we're going to talk about it more, of course. We'll speak to Jumana Salihin, chief economist at Vanguard, on the UK's shrinking economy here on Bloomberg Brief.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Today, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg surveillance. The Fed decides. Today on Bloomberg.
It's Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Manus, we knew that insiders were trying to sell their shares of SpaceX, and now we have a new price tag on those shares. It's now going to be $97 a pop. That brings the total value of SpaceX to $180 billion, putting it just behind ByteDance as the second most valuable, closely held startup.
Well, that's just ramped by $5 billion. Last week when we did this story, it was $175 billion. So we're at $97 a piece. So if you're an employee with stock in size, you're getting richer. By the way, 90 successful launches of its Falcon 9. And Starlink, of course, Starlink is the other hidden value there. 5,000 satellites in low Earth orbit. Quick line on Netflix, Danny. This is, the number one. They've decided to show and tell. Post the actors' strike and to really make the stock more robust. What's trending, what's had the most views, and the night agent comes in number one globally. And I got to say, it's brilliant because you don't know who done it to sort of pretty much near the end. I got to say, I was glued to the night agent. But I think you were a little bit more taken by something else, were you? Per chance?
No, well, I was going to say, I haven't seen it, and I feel kind of bad because apparently I'm, one of the few people on this earth who hasn't. You know what's kind of crazy? This report they have covers 18,000 titles. You have to feel so bad for the poor Netflix analyst who had to put this together. That is like that's like investment banker level, staying up until 1 a.m. every night. But Manus, you're right. My favorite show on that list is Queen Charlotte. I love the trashiness. I love it. I love Shondaland.
Well, you know what, Bridget and Queen Charlotte, it all sort of run. There you go. And actually, it was pretty brilliant. I watched that before I left Dubai. I've got to say, there's some pretty good stuff on Netflix at the moment. There's the moment.
Well, you know that scene where they're kind of going into the castle. Last year, when I was looking for a wedding venue, I actually went to that exact place and walked through. This is before I had seen Queen Charlotte, and they were like, okay, you can only do it now because we're going to shoot a Netflix show. I didn't go for it, Manus, but had I known Queen Queen Charlotte was going to be shot there, I probably would have booked it. This is how I run my life.
You're just packing it all in before you actually come to America. You're getting the full British kind of consumption of British aristocracy and royalty. Let me just be a little bit more sober with you, which is the price of the British government bonds. Because stagnation nation is taking hold. The market is ramping up. It's rapid demand for rate cuts. Nearly 95 basis points of cuts are there. Yields drop in the UK, 3.9. I need to get the old sterling deposit on quite quickly, lock it in for a year. Yields drop in Germany, and US Treasuries trade down to 4.19. Roberto Gallo says these markets are complacent and they are buying like Billy, a little bit too much, too soon, and too aggressively in the bond market. Good morning from New York and London.
On the product may read made in the USA, but the sign on the CEO's door often says made in India. Alphabet's Sundar Pichai Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
It's Bloomberg Brief on a Wednesday. I'm Manish Kraney in New York, Danny Berger in London. Now, shake it up. Argentina's injecting shock therapy to the economy. The government has devalued the peso by 54%, overhauled a crawling peg, and announced a massive round of spending cuts. It is the newly sworn-in President Javier Milei. He takes his first steps to pull the nation out of an economic crisis. Will it work? Ziad Daoud is our chief emerging markets economist. I mean, he went straight for slash and burn. A massive devaluation in the currency. Is that step one to progress? Good afternoon to Dubai and Ziad.
Good afternoon to you, Manus. The new president has moved fast, but he moved in a predictable way. He moved on two fronts. On the currency front, he devalued the currency by 54%. And because the new official rate is still below the parallel market rate, they expect the currency to weaken 2% each month. So that's on the currency front. On the government finances front, the new government is slashing spending, is reducing spending to pensions, is cutting subsidies, and is also increasing taxes. So overall, what are they trying to do? They're trying to fix the foreign exchange market. They're trying to reduce the government's budget deficit. But all of that is coming at a cost, and the cost is growth. So our team expects Argentina to contract next year, and that's on the back of an expected contraction this year. So 2 years of negative growth in Argentina, and that's the cost for fixing the FX market and reducing the government budget deficit, which is the source of all problems in Argentina.
Well, I mean, it's interesting. We had a president in Argentina 8 years ago who tried to do something kind of similar, 26% devaluation. Obviously, that didn't draw a line under the issue. But Milei doesn't want to just do that. He's also pledged more drastic steps in his election campaign, like dollarizing the economy, abolishing the central bank. Ziad, what would those things do to the Argentinian economy? And is it expected that it will actually happen?
Well, it might happen, but it's unlikely to be imminently happening because Argentina doesn't even have enough dollars to replace all the local currency in circulation with dollars. If they do it imminently, then that means a even sharper reduction in the value of the local currency. And if you think negative growth and recessions are bad, an imminent devaluation can basically send Argentina into a depression. Is it completely off the table? Our economist, Adriana De Pita, doesn't think that the idea of dollarization and abolishing the central bank is completely off. She thinks the president might be postponing rather than abandoning this idea. He believes it would end the inflation problem. It would end money printing from the central bank. And because the government will not have readily available funding for its budget deficits, it will reduce the government's budget deficit. But it's unlikely to happen very soon, Danny.
Let's just round off, Ziad, with a top thought from a helicopter view. Do you think this is an isolated kind of policy reaction event in Argentina, or is this a more general trend that you can draw on EM?
It's a sort of a mini trend that we're seeing in EMs, Manus. So if you think about 3 case studies, Argentina, Turkey, and Egypt. The 3 countries have high inflation. They've had the worst performing currencies among major emerging markets since the beginning of 2022. So that's one thing in common. Another thing in common is elections. Turkey had elections back in May. Argentina had elections which brought Milei to power in early December. And Egypt is literally counting the vote now. And the third thing they're doing is a pivot in economic policy post-elections, but they're doing it in different intensity. Argentina is going for radical shock therapy. Turkey went for sort of orthodox economics, raising interest rates and giving central banks some independence, and we'll see what's going to happen in Egypt after the vote.
Yeah, certainly will. Ziad, thank you so much. Ziad Daoud, Bloomberg's chief emerging market economist. All right, Manus, some breaking lines on Tesla to bring you. Tesla has filed for a recall of 2 million vehicles on autopilot. Flaws are going to release an over-the-air software update, and shares falling about 1.5%, Manus. They also had a recall in China just back in October. About 5,000 cars in China they had recalled on an updated brake issue. So again, that's 2 million vehicles, Manus.
Yeah, so that takes a little bit of a knock, but as we just said, SpaceX, which is the other major innovation within the Musk empire, rises in value. But this is an over-the-air update to fix the problem. More on markets with Danny and myself in just a moment.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
DOJ or other authorities
could face bigger challenges. Britain's next.
Was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Here comes the Fed. The central bank is set to hold rates steady after the latest CPI print reeled in rate cut bets. Shock therapy, Argentina devalues the peso and announces massive spending cuts to revive the nation's troubled economy. And SpaceX value soars to $180 billion, illustrating strong investor demand for a stake in the Elon Musk startup. The past 24 hours have been very strong for risk, despite the fact we did have a little bit hotter than expected CPI coming in. Nonetheless, S&P 500 futures are now trading at a 20-month high. Goldman says beware the CTAs. Regardless of what happens, they will be selling next week, but the choir is growing for more gains to come next year. HSBC says we're going to hit 5,000 on the S&P 500. VIX, that drops to a pre-pandemic low, about 12%. It is moving a bit higher today, though. You can see that on the bottom of your screen. Meanwhile, NASDAQ futures, these are just 1% away from an all-time high. Again, the big cap, the Mag 7, really carried us in gains yesterday. But China not playing along, Menace. These shares in China ending the day down about 1.7%. We had the economic meeting coming out of China, but no silver bullet stimulus to act as a catalyst for this equity market to move higher.
Yeah, and the accusation is there's a lack of innovation, a lack of size and scale in stimulus. One thing is for sure, the bond markets are lit up. We have this panic buying, according to Alberto Gallo. So you have this almost FOMO in the bond market. Yes, you've got flatlining growth, stagnation nation in the UK, yields drop in the UK. Again, the market baying for nearly 95 basis points of rate cuts here in the UK, baying for 100 basis points of cuts here in the United States of America. What will the Fed do to push back on that in terms of rhetoric, in terms of the summary of projections, and in terms of the dot plot? There's a complacency in these bond markets, according to Alberto Gallo, but he still likes credit and he still likes high yield. He still feels that there is an appetite for that. We may be in this higher for longer, and that's why you may get a reset in the bond market. Oil drops ever so slightly this morning, 65.58. The Russians just keep shipping crude. It's almost like the anti-OPEC plus narrative. Everything that Saudi Arabia has done is being undone by US supply and by Russian supply. And to that end, you'd pretty magnificent drop in the oil prices. We'll bring that question, of course, to our next guest. What should we read from this drop in oil prices? So far this year, down 15%. Does that assist the central bank? Because it certainly assists in the pocketbook of your average American driving out there. Danny.
Menace, let's get more into that UK data. You mentioned it. We have the chart of the growth we saw in October. It did contract more than expected, 0.3%. It's higher borrowing costs. It's even that wet weather, which I don't know why this would shrink things, because that's literally always the weather here. Menace, you made fun of me for calling it, loving the phrase stagnation nation, but hey, Alberto Gallo agreed. That's the risk for this country.
It is. It is that, and also if we look at the markets, 150 basis points are expected from the ECB, nearly 100 basis points from the UK. They went from being on the front foot. If you look at the Bloomberg opinion column, Bank of England went from being on the front foot of hikes to the laggard, really, in terms of capacity and scale of cuts that they may well be able to deliver next year. Danny.
Well, let's get to someone who knows this much better than you or I. It is a former BOE official. Yeah. Joining us now is Jumana Salehin, Chief Economist at Vanguard. Jumana, really great to have you on the program today. Stagnation nation, is it fair to say that stagnation will continue to be the issue that the UK economy is dealing with well into 2024?
Yeah, thanks a lot for having me. Yes, I think the UK economy, there's a number of structural factors and there are a number of cyclical factors, which is why that stagnation nation, phrase has become very popular. So on the one hand, on the structural side, the long-term side, we expect the trend growth rate for the UK economy is 1%. That's half of what it was before the global financial crisis, where it was 2%, and it's below what we're seeing in other major advanced economies, where it's a little bit higher. So that's on the structural side. In terms of 2024, which is the question you asked, we believe that monetary policy will continue to bear its teeth in 2024. And so with respect to that, we do see a weakening of growth, particularly in the UK, where we do see growth falling, and we're still pricing in a recession end of this year and into next year.
Jumana, good morning. Good to see you. So pricing in a recession, you see a deceleration in inflation or a continued disinflation narrative. What I'm trying to square away is, will the speed of the disinflation be commensurate with the 100 basis points of cuts that the market is assuming the Bank of England will deliver? Because 100 basis points of cuts, in my view, that's not a soft landing.
So thanks a lot, Marcus, for that question. It's actually quite difficult to say what's actually going to happen. At this moment in time, it does feel like markets are pricing in too many rate cuts for next year globally, right? Not just for the Bank of England, the ECB and the Fed as well. And of course, data dependency is going to be the key point that we look at going into 2024. If things pan out as we expect, it probably won't be that, full 100 basis points that's priced into markets now. It will probably be less than that. But the key point is we don't actually see any rate cuts from the Bank of England until the middle of next year.
It's interesting, kind of in the wider context. Ellen Zettner made this comment that 2024 is a transition year, that it's a turning point for the economy, it's a turning point for monetary policy. I can't help but wonder if that kind of thought just comes from, the arbitrary delineation of time that in 2024 something's going to happen. But I wonder what you make of that argument. Is 2024 a turning point for this global economy, and what would that actually mean?
So I think you can come at that in many different ways. I think our view at Vanguard really is that we are already at that turning point. We see that we're entering this new world, a return of sound money, where we see the R-star, we talked about this last time, we see the equilibrium interest rate globally is going to be higher. So although cyclically in 2024 we do see those rates coming down from the cyclical highs where interest rates are in restrictive territory, as we move to those more neutral territory, the key point in the turning point that we want to say is we're not going back to zero interest rates. And that's a really important, it has significant implications for the global financial markets, but also the global real economy.
But here's the debate, Joanna, isn't it? If we're returning to a higher average R-star than what we've had for the past 10 years, look at the speed with which we got to 500 basis points and 525 basis points. I think what we're trying to get our heads around from a market perspective is how quickly do we revert to this new mean, as you say, we will arrive at, because they got to 500 basis points pretty darn quick.
I mean, I don't think it was that quick, right? It took over a year to get to that point if we're thinking about the Bank of England. So it did take some time. And
well, from zero for 10 years, I got to say, it was a bit of a shock when I looked at my mortgage slip from the UK.
Yeah, sure. Yeah, no, if you're talking about that longer-term context, relative to what we've seen in the global financial crisis, yes, absolutely. Within 1 year going to 5, we didn't expect that. There were quite a lot of surprises on the upside. But to your point of, where do we go from this point onwards and how long is it going to take? Really, it depends on the economy. In our own forecast at Vanguard, we are expecting inflation to go back down to 2.6% by the end of next year. And at that point, we expect to see the unemployment rate rise. So, you could be seeing that we're going back to those neutral rates towards in 2025. So we'll start that journey and have quite a significant one in 2024, but we're not going to get there.
What does that mean for corporates? Oxford Economics put out this number saying that the amount of maturing U.S. debt will double in the next 2 years to $1 trillion in 2025. In Europe, it's a tripling of the amount of debt, but lower overall, $400 billion. Is that, again, not normalization to zero, but a move downwards? Is that enough to save corporates who are going to be facing a maturity wall?
So I think it depends on what that maturity wall looks like. And we know that corporates took advantage very much of that low interest rate environment and they switched around their balance sheets. So it will take time for corporates even to roll over that debt. It depends when, similar to mortgages, right? It's when your mortgage comes up for renewal. So that pace will actually be quite slow. And we've done some work in our annual reports showing that for the US in particular, it's going to take some time for that to come through.
That was a rude wake-up call for Manus, who just learned the glory of the land of 30-year mortgages.
Let me explain to you. You should open your statements from your mortgage lender more often than I did, which was, whoa. Forgot to raise that payment. Jumana, thank you very much. Great context around what we can expect for 2024. That is Jumana Salahin joining us this morning. Quick snapshot of where we are with markets. There is a complacency in taking on too much risk, according to Alberto Gallo. Stocks are a little bit higher on this Fed day. Let's see what the FOMC delivers for us. The dollar is bid up by an eighth of 1%, and 10-year yields drop ever so slightly, 4.18, but we are in full panic buying mode, according to Alberto Gallo at Andromeda. Good morning from New York and London.
Is a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report, tonight at 9:30 Eastern. Bloomberg, context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
For the first time in the history of our regime, the decision, supported by all nations of the world, calls for transitioning away from fossil fuels in energy systems so as to achieve net zero by 2050. Many people here would have liked clearer language about the need to begin peaking and reducing fossil fuels in this critical decade. But we know this was a compromise between many parties.
That was the special presidential envoy for climate, John Kerry, speaking about the landmark COP28 deal that was sealed in Dubai. Joining us now on the ground is Jess Shankerman. Jess, I mean, the significance of this, it is a transition away from a naming of fossil fuels in a COP agreement. Is it that historic, or what needs to happen to endorse this, to deliver this?
It's absolutely historic. It's the first time, as you say, that we've had an agreement on fossil fuels in the 3 decades of the COP process. It's not the phase out or the phase down of fossil fuels that many countries wanted, as we just heard John Kerry saying, but it is still significant. However, what Dr. Sultan Al Jaber, the COP president of the UAE, has been telling delegates repeatedly today is what will change the economy is really how this language is translated into boardrooms, into government, and into the choices that consumers make as well.
Right. Well, that's the thing, Jess. In doing this, it's not just some diplomatic agreement is going to mean there's a specific timeline. So how quickly could this actually become reality, that the world moves away from oil and gas?
So the text does put some time frame into it. It talks about accelerating the shift away from fossil fuels in this decade. And what is interesting about that is that carbon capture and storage technologies, direct air capture, which are the kind of technologies that oil producers want to rely on to reduce emissions, aren't going to be ready or commercialized sufficiently this decade because they're still way too expensive and way too nascent. That means that we will have to see real cuts in oil and gas in order to deliver on the promise of this UAE consensus, as the text is known. But as I said earlier, how it's going to be translated, it is a legal text, but how it's going to be translated by governments remains to be seen, because in Glasgow, 2 years ago, we had an agreement on phasing down coal, and we've seen an increase in consumption of coal since then, largely as a result of the war, of Russia's war in Ukraine.
Well, Jess, we got there. We did get a deal. Finally, I know you've been waiting for it. Thank you for covering it for us. Bloomberg's Jess Schenkelman in Dubai. Jess can finally get some sleep. All right, let's now turn to Washington. President Zelensky heads back to Ukraine with no clear commitment of financial support from the U.S. President Biden appealed to lawmakers to break the deadlock on Ukrainian aid.
Holding Ukraine funding hostage in the attempt to force through an extreme Republican partisan agenda on the border is not how it works. We need real solutions.
Let's get to Kate Ackley of Bloomberg Government, who's in D.C. for us. Kate, very difficult timing for President Zelensky, a divided House and Congress, potentially more focused on Israel at this very moment. But Zelensky goes to Capitol Hill. He holds meetings with the House and Senate leader. Did he actually get anything for it?
You know, that we're going to find out over the next few days. But as of right now, it seems like it was sort of a mission impossible for him to convince, skeptical Republicans, particularly Republicans in the House, that they need to move right now by the year's end on getting some of that aid to Ukraine. They've tied it to these border negotiations, a border measure, and there are ongoing negotiations. There's high-level staff, people from the administration, but there isn't, a deadline per se that something needs to get done. And Congress is looking to leave town after this week.
Well, of course, the other major issue is the Israel-Hamas, the support from the U.S., from the White House. If you look at the readout, Biden is now warning Netanyahu, be careful, because the world's public opinion can shift. This is a seismic shift from the White House. You must change or lose global support. Contextualize the shift.
Right. Well, this is the first time that this is kind of spilled into the public view. I think there's been a lot of the government will shut down in January and then again in February. if there isn't some kind of bipartisan agreement. So they've made it so that they have to do something, otherwise parts of, or the government will shut down early next year.
Okay, well, Zelensky returns. I mean, it's a very big pivot from where he was just a year ago, addressing Congress in sort of full flow. So a pretty big pivot there on all fronts, on Ukraine and on the US's rhetoric around Israel. Kate, thank you very much for getting up early. Kate Ackley there, a Bloomberg government reporter in Washington. FX could be a little bit more dramatic as the day rolls on, certainly on the pound. Drops this morning in the first instance as we see a slowing in the UK economy, and so the rates market is moving more aggressively on rate cuts in the UK. 125.13. The dollar, as you can see, is up by an eighth of 1%, so a portion of that cable move is down to dollar strength. Euro drops. By the way, 150 basis points of cuts are assumed by the market in Europe for next year. It will be the ECB that will outgun both the Fed and the Bank of England, according to the rates markets right now, Danny.
Well, before we can get there, though, we have to get through the Fed and some of the other market-moving events. We're going to give you the diary, all the events to watch throughout the day, next here on Bloomberg Brief.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Let's get you set up for your trading day. Here's a look at what's ahead. We're going to have more eco data out of the U.S. PPI numbers will come out at 8:30 a.m. Eastern. And then it's your main event. It's the Fed rate decision. That will come at 2 p.m. Of course, it's going to be followed by Chair Powell's news conference at 2:30. And then after the closing bell, we have Adobe fourth quarter earnings. The company is expected to show steady growth. So we still have this drip feed of earnings, Manus, but there are other company news that's moving in the pre-market session.
Yeah, we got Tesla. they're going to recall 2 million vehicles. Now, they've got a fix. This is on the autopilot safety system. The US regulator found that the system doesn't do enough to prevent what's called misuse. So we have this recall. They are offering a fix. So the question at the moment, I mean, Tesla, as you can see, is down 1.125% this morning. So that's a little bit of a left field. There's probably 2 million vehicles involved in this recall, Danny, and there will be a release of an over-the-air software update.
Well, and you can also see on your screen there, Walgreens Boots is a little bit higher. It might just start to become Walgreens and not Walgreens Boots. They're reviving the consideration of exiting their Boots listing. They're thinking about maybe a London listing for Boots Pharmacy, an IPO. And man, it's just to kind of tie this back into the wider macro picture. If you're looking at a stock market that it's better behaved, it's rallying more, then you're going to start to get all of these IPOs, which had really been backed up by the volatility of the market, finally start to come out. And that's very much so a real world example of what the Fed, the BOE, the ECB is dealing with. It is financial conditions that have started to loosen, and you're going to get things like IPOs, again, that kind of revive this market and do the opposite of what they want to happen.
Look, absolutely, and I think at the same time this could be a mini win for the LSE because it has been quite battered and bruised this year with some of the bigger IPOs that have sort of gone stateside. So I think in that respect, if it does come to pass, I mean, Boots has been has sort of flopped and changed in terms of ownership in the past 30 years. So for the LSE, if that is what comes to pass, it could certainly be a winner. Let's stick with the UK because one thing is not a winner. Growth is under pressure. So we've got this moniker, stagnation nation. We're just with Jemana there, and she was sort of talking about the propensity from the Bank of England. What you can see here, Danny, is 10-year government bond yields, and indeed twos. Twos are dropping even more aggressively than 10. So you have this bull steepener going on in the rates market in the UK. Baying for rate cuts, nearly 95 basis points of rate cuts are there because we saw that slower growth in the United Kingdom.
Right, and back on November 27th, Andrew Bailey had said that it's too soon to have that discussion of cutting. Jomana figures that that's going to be kind of the similar language coming out of the BOE, and will it be the similar language coming out of the Fed, Manus?
Yeah, look, this is going to be, there's no doubt about it, the rates market is on fire. We've had a message from Alberto Gallo saying that we're slightly over our skis, and there's a complacency in risk. From brief to surveillance, good morning.
If you're losing more than half the electricity you put into electrolysis, is it a viable alternative to some of those fossil fuels?
Yeah. I mean, have you heard of oil? Have you heard of gas? I mean, you convert oil out of the ground, refine it, turn it to diesel, whatever you like, which is going to cook the planet. You've already lost 60 to 70%. I mean, yes, there is a conversion loss from not losing an electron going from wind and solar straight into the grid. That's why it's the lowest cost energy in the world. But there's a conversion loss. Oh my God, a conversion loss. The oil and gas sector, green hydrogen's got a conversion loss. It's like putting lipstick on a pig from the oil and gas sector. They have had a conversion loss since 1810, right? And remember, relative dollars, their dollar per barrel was $1,600. Let's not forget that. That's how they got going. Subsidies, $1,600. Wow, it's better than burning wood. Now the same companies stand in the road of green hydrogen and say, oh my God, it's not as efficient as us. We've only had a 200-year head start, hundreds of trillions of subsidies, which we've swallowed from taxpayers. They should get none, and they want to do it in 8 or 9 years. You know, who would you back? I'd back us.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Right now, it's a Fed pivot party, and we're all invited.
The key thing is that we are seeing inflation slowing, and it's consistent with what the Fed expects.
We've hit peak rates. We've hit peak Fed. Inflation is slowing.
Well, I think inflation and vol are moderating. I don't think we're going all the way back to where we were in 2019.
If we see stability in inflation, and then as we move the calendar page into 2024, we see a little bit of an uptick, I think that could force the Fed's hand to take one final rate increase.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Fed Decision Day, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P just about positive by 0.1% on the S&P 500. Three-part story this afternoon: statement, projections, news conference with Chairman Powell. TK, will Chairman Powell RSVP to that Fed pivot party?
A lot laid out in the last 24 hours. People writing up different notes on the what-if, plug-in, change the numbers. You know how they put it up, John? They put the statement up, and then they put up the guesstimate statement, and then it, you know, to whatever, they'll have the, this is what they actually said statement. I'm more focused on the dispersion of the dots. I usually wouldn't say that, but this time around, I think everybody's got to readjust, recalibrate.
Without a doubt. I don't know, but he's up to speed, which is refreshing.
Yeah,
Thanks for that,
well,
TK.
You know, once a year. I mean, I looked at the auctions yesterday and was absolutely shocked how we popped off the 30-year
Pretty
auction.
decent. Has
Merry
there been
Christmas.
like some kind of swap here? I don't know. Anyway,
He's wrong.
The 2024 dot, is that what TK
Good.
is? That's right. That's
Make
right.
a banner,
That's
please.
right.
Tom is wrong. On radio, you're going to see
I
it.
disagree, and then say exactly the same
exactly,
thing.
yeah.
Okay, 2024 dot, how many cuts are going to be implied by that 24 dot, Bramo? Based on where we are right now in this market, will it be enough? I guess the question is, how much daylight will there be at the end of the day between the market and the Federal Reserve?
In other words, if they say, as many people expect, that they're going to cut rates by 50 basis points, yes, they're moving it up by 25 basis points for the full year, but very different than 100 basis points that the market is pricing in. Does the market discount all of the Fed's projections and say, we still go with our estimate? Good luck trying to message what you're saying.
We've got a bull coming up, John Stolfus of OPCO, but, you know, John Farrow, I'm looking at the Bloomberg Financial Conditions Index of a 0.60. Chairman Powell goes into this with a screaming accommodative statistic.
You say we've got a pull, and we're talking about people looking for 10% upside in 2024. Since the Fed last met, Tom, the S&P 500 is up about
And look at the
10%.
bond market.
Never mind bullish for next year. The last month, TK, has been absolutely
And
ridiculous.
the 10-year yield, 4.18%. That surprised me walking in this morning. I mean, I thought it'd be like a 4.22, 4.25, whatever. It just doesn't want to go higher yield.
At least so is Chairman Powell pushing back a little bit later.
If he doesn't, how much does that signal, let's go, bull market, game on, go even further? Because at a certain point, people expect him, sort of the expectation for today's meeting is he's going to push back.
Okay.
If he doesn't, how much will that surprise the market to basically say, okay, you want to be the most accommodative since we started raising rates? Well, you know what? That's probably okay.
Somebody's going to ask a rude question. Let's go with Gina Smilek at the New York Times. She's going to sit there with an exceptionally rude question, probably get Taylor Swift into it, and he's going to go, John, to a prepared statement. Folks, this is the way this works. Lagarde's the same way. They read from, does Bailey over at Bank of England? I don't know, probably not. They're going to read from a prepared statement.
He is right now.
What is that statement? The three of us could write that statement right now.
He has spoken recently.
Yeah.
Will he just repeat what he said recently,
Yes.
which is too premature to engage in a conversation about interest rate cuts? The problem is Governor Waller's already gone there.
Yeah.
Governor Waller's
Noted.
already gone there.
Yeah.
And Bramo, I just wonder, that's the question people are going to ask in the news conference. We know that. Mike McKee, if I was Mike McKee, I would just quote Governor Waller and say, thoughts? Thoughts, Bramo? Thoughts?
Well, here, part of the problem is even if he repeats what he said, that will be viewed as really dovish. The only thing that he could say right now is if he comes out and says categorically, we don't think it's appropriate for people to be celebrating victory at this point. We haven't reached it. We are not on board with that. If he explicitly pushes back on some level and says, look, you could talk about theoretically all these cuts that you want, but we're not there and the market is really getting ahead of itself, that will be a real signal. Anything barring that is basically a firing gun for the next leg of this rally.
I know we got to move on, but the Supercore, this silly breakout that Mike McKee does, the Supercore statistic yesterday was sort of flattish. It was not disinflation-y, so he can lean on that.
It just didn't do enough to upset the narrative of the last month, that's for sure. And if Chairman Powell pushes back, how credible will it be with this market, which is just on another planet, looking ahead to 2024 and bringing forward those gains? In the equity market right now, we're positive 0.1% on the S&P. Wow. Here are the scores. Yields lower by a single basis point, 4.1852 on a 10-year. And the euro, just a touch weaker here, Lisa. Euro dollar, 107.74.
I love seeing 4,700 in the S&P. It basically is the year-end targets for 2024 a month ago. I'm looking right now at 8:30 a.m. U.S. November PPI Producer Price Index. This, to me, is going to be key to understanding margins. We basically saw a disinflationary trend. Does it hold? The expectation is it actually reverses a little bit and bounces back. At 1:30 p.m., we're back on air. Surveillance is the Fed decides.
We are?
Get ready. We are. You'll be there. J.P. Morgan's Priya Misra, Deutsche Bank's Matt Lazzetti, Michael Cape, Bank of America. Hold us together, Tom and John. Bill Dudley, former New York Fed president, and a host of others to really give the drumbeat to this rate decision and then commentary after it. 2 p.m. is the rate decision. I am less interested in that. I am more interested in the SEP, the Statement of Economic Projections, and then the 2:30 p.m. news conference by Fed Chair Jay Powell. How much does he push back? Yes, it matters whether people believe him, but even more, if he doesn't find it necessary to explicitly push back, how much is that going to be taken, again, as basically confirmation of the moves that we've seen in the market already?
The last working day of the year. Is that official? No?
Are you never
not
coming
quite.
back for the rest of the year?
No, just saying. Not the last day. It's tomorrow morning, the last day?
Tomorrow, Bank
Retail
of
sales.
England, we've got
Second-tier central banks. Second-tier central banks. Don't worry about it.
You could say that, I
Second-tier
can't say
central
that.
banks.
Carry on.
We're doing second-tier central banks tomorrow.
Yeah.
Okay.
I'm
all right.
embarrassed. They're not.
So we get to one of Wall Street's biggest bulls. He's calling for the S&P to rise nearly 13% next year to 5,200. John Stolfus of Oppenheimer writing this. We look for 2024 to be a year of transition as markets navigate what we expect will be the Fed's pivot from a restrictive monetary policy setting to an easier stance. John Stolfus, I'm pleased to say, joins us right now. John, I actually think your call is original in the sense that I don't think it's too dependent on rate cuts next year in quite the same way as it is elsewhere. John, can you just go through your framework, the path to 5,200 on the S&P?
Yeah, great to be on surveillance as always, John. You know, the thing about this is, when we look at it, we think the traders right now are pushing this dream of 4 rate cuts next year. We think the economy is showing significant resilience in the face of 11 hikes and 3 pauses thus far, or skips as the Fed prefers to call it. The Fed has shown remarkable sensitivity as it practices its mandate to keep untoward levels of inflation in check. And so all in all, we think this looks good, as with cuts likely to happen in the second half of the year and probably maintain mostly, if it's going to happen, probably in the fourth quarter and then only once or twice.
John, there is a shift going on. I saw it from our Gina Martin Adams at Bloomberg Intelligence. It's obviously Stolfus 101. And also the great Urian Timmer, chart guy at Fidelity. There is a shift to earnings analysis. We're moving away from Fed navel gazing to OMG, look at revenues, OMG, look at earnings. We've seen this before. How does the market react?
We think the market is actually well positioned to react positively to it. It's not only about traders, it's intermediate and longer term investors and traders that create the environment. I mean, the markets are like music. It's math and emotion. It's fear, greed, and need. So some people invest for need, others invest for the short term, the fear and greed aspect. And we think it creates, I don't want to call it a cocktail because that sounds a little bit too volatile, but it creates an opportunity where if we focus on earnings in an environment where it's the end of free money, where bond issuers have to pay for the privilege of borrowing money and bond buyers get something in return, this just looks like a more normalized environment, and we like it.
Does it make you nervous that everyone seems to be agreeing with you these days?
Oh, it sure does. That's the one thing. You know, we saw an awful lot of the bears who last year were telling us about the pending recession and the massive unemployment that was coming and all this stuff that was negative. They took the negative pitch book sold last year, and it's what we believe really caused the market to decline as it did last year on things that were never realized. And so the bears have pivoted. But when they pivot, you get that feeling if you're on a boat, all of a sudden everybody's on your side of the boat. You start looking for a little ballast. And that might well be in terms of taking advantage of some of the diversification that fixed income offers, as well as other areas of the market, of the equity market, that have yet to participate in this rally.
So does that mean, John, that you're broadening out to small caps, to some of the less loved areas, away from just focusing on big tech?
Yeah, you know, Lisa, we've been working with better quality small caps on an alpha basis, and in terms of on a beta basis, or using the passive indexes, using the S&P 600 ETFs versus the Russell 2000 for that purpose for quite a while. It's hurt us in terms of overall performance, but it's given us stability. We can't help but notice on days when there's volatility in the market that's caused by nervous money pulling out of the large caps. Usually, these days, they're going into the S&P 400 mid caps or the S&P 600, or when the tide comes in and all ships are floating, they roar into the Russell 2000.
John, what's a comfortable price to earnings ratio? Right now, we're at 21 SPX. Obviously, there's been multiple expansion, but what's a historically comfortable PE for our viewers and listeners?
I think, Tom, when it comes to historical, you got to think the generations. I can't help but think Leon Cooperman's ratio is probably about 12, is the most 12 times. For most boomers, it's around 16. And as you get younger, the generations keep pushing that multiple up. Some of that is probably because they recognize, some of them, it's just a more aggressive positioning, okay? But it also has to do with the need that I think people are beginning to realize that Social Security will not be in the same stead that it was for many decades for generations to come, and people need to invest. And it's just like real estate in New York. You know, back in 78, you could buy a co-op really cheap. Even today, with all the problems the city has, gosh, if you look at the prices on co-ops, at least the ask is just, you pale at looking at it when you give it a historic comparison. We think equities move higher here, so probably 21 to 22, and I'm not a gunslinger. It's just that the demand for equities, when private equity has taken so many stocks out of the market, that it creates demand that is chasing supply.
John, let's have a good rant about co-op fees another day. Love that. John Stolfus of Oppenheimer Asset Management. John, have a wonderful Christmas. It's great to catch up with you, sir. He has had a wonderful year. The last 2 years have been absolutely bruising. TK, think about it. You get 22 wrong, you better get 23 right, because this equity market is back to where it started at the start of 2022.
The constant theme of these smart people is not so much they were right or they got a statistic right. Binky Chadha at Deutsche Bank would be a perfect example. They didn't go to cash. Market timing. There's been a lot of academic work on this. I go to UMass and Vanderbilt leading the way 20 years ago. There's been a lot of academic work. Cash, I'm in. Cash, I'm short. Boy, that's a tough game.
How much is what's underpinned some of the faulty decision-making, this reliance on the Fed? This reliance on Fed monetary policy as sort of a guiding light. Whether they hike, that's negative. If they cut, that's positive. Versus, that's less of the game than the profits and these other things in a normalized type of environment. And that's what we just heard from John Stolfus.
Did you notice that we've already had the Fed meeting in Washington with Chair Yellen and Vice Chair Biden?
Ooh,
did you notice that in the last couple of days?
Pretty awkward.
Yes. Didn't go
Chair
unnoticed.
Yellen is sprightly.
Things to say on inflation and the path back to 2%, soft landings and all that good stuff.
Yep, prices coming down from Biden.
Quite a team, eh?
Yeah.
Chair Yellen, Vice Chair Biden. We can talk more about that in just a moment. Gagi Chowdhury of BlackRock in the next hour on Bloomberg TV. Right now in the equity market, S&P 500 futures just about positive. From New York City this morning, good morning. Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Today, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg.
I have had conversations with Bibi Netanyahu, and I want to make sure that we don't forget what we're doing here. We have to support Israel because they're an independent nation. I think that we have made it clear to the Israelis the safety of innocent Palestinians is still of great concern.
That was President Biden speaking at the White House after comments made at a fundraiser in which he alluded to Israel losing global support for indiscriminate bombings in Gaza. We knew there was some kind of divide behind the scenes, but Tom, publicly, we're starting to see it more. It started a few weeks ago, in the last couple of weeks, with Vice President Kamala Harris, and now you're hearing it from the president himself.
There's no question about it. Just in the last 24 hours, it's all been and confirmed. Certainly, that was the. It's shocking over 12 months to see the difference in Mr. Zelensky coming to Washington as before. I mean, I just simply did not expect it, and here we are. No question.
I also think that when it comes to Israel, there is this question about Benjamin Netanyahu, who did not have a lot of support, who is much more on the right wing, and how he's going to position going forward, given the fact that he is taking a different stance from what President Biden would like to see. A lot of people are just saying the bottom line is it has to wrap up in a couple of weeks. That's what people seem to be feeling and saying pretty collectively.
The polls are screaming. TK screaming.
Yeah.
In opposition to the president's stance. Let's be clear about this. Well, in the latest poll from Gallup in the last month, half of those surveyed said they approved of Israel's military action in Gaza. 45% of Americans disapproved. But the key part of this survey, 63% of Democrats disapproved. We're going into an election year. It's no shocker to me that the president's coming out and changing his tone.
And it's not just this poll. I was thunderstruck yesterday and the day before at the polling of the mayor of New York City, Mr. Adams, getting terribly low polls, much of it because of the migrant debate within New York City. And that brings it over to the border debate, which is now directly tied into the Ukraine debate. And the polling on the border, again, is distant, John, from the zeitgeist inside the Beltway.
And we're set up for this big fight, Tom, into next year. Overspending, aid to Ukraine, aid to Israel, cutting spending, doing something about the southern border.
That's where we are right now, and as we adjust and adapt into the new year, and of course the beginning of the presidential election, look for us, Anne-Marie Horton, leading our coverage in January as we look to Iowa and look to New Hampshire. It is a good time to check up with someone steeped in political history of America. Wendy Schiller is the director of the Taubman Center for American Politics and Policy at Brown University, Providence, Rhode Island, but far more in her textbook, Definitive on Teaching the Civics That We Have Forgotten. Wendy, if you look back at our civics of 200 years, in the mess we're in now that John beautifully stated, what have we most forgotten?
Well, I mean, I think when you think about the American ideal, it requires tolerance. It requires saying, you disagree with me, but you and I are both American, and we all share in these First Amendment values, or the 10 Bill of Rights values. This is the system of government that came from nowhere. I mean, the founders, cribbed from lots of history, but nonetheless, we agree that the price we pay, or the ticket to entry into this democracy and to stay in this democracy, is tolerance. We can disagree. We can win battles politically, we can lose them, but we all have legitimacy. And that is fraying. That is fraying in a way that is mass-based now, which is different than, as you point out, Tom, historically.
So the litany that John just stated on Ukraine, on the border, the migrant debates and all that, do you see us engaging this debate in 2024, or do we engage it the first Wednesday of November 2024?
Well, I mean, I think we engage it the minute Donald Trump wins a primary or a caucus and gives an acceptance speech that is covered by everybody, and Donald Trump becomes our daily dose. In other words, we get a diet of Donald Trump every day, multiple times a day. And what is his language? How does he speak? You already see Kevin McCarthy, who I know is out and leaving, but saying revenge and retribution won't work because it is antithetical to what people want to believe about America. Let's go back to Ronald Reagan. We're old enough to do that. I think that's a good thing, generally speaking, in terms of understanding which messages work in times of difficulty. 1980 wasn't fun. Let's remember, 16% interest rates, the hostage crisis, the world was becoming less stable. Ronald Reagan said, we can do it. We're good, we're exceptional, we can do it. George W. Bush, same message in 2000. This is the message voters respond to. So this is the question mark for Donald Trump. Does he go that dark and negative and still manage to be able to win?
How will history judge, Wendy, President Biden's decision not to step aside and let another Democratic candidate take his place?
Well, I'm still dug in on the idea that he doesn't step aside, although it's starting to waver just a little bit. He believes that he is the most experienced candidate. He believes he's the only person who's already beaten Donald Trump, and you have to shake him of that belief. So if there are poll numbers out there that show somebody else can do it more easily and more definitively, then I think he'd listen to that. But clearly there aren't. At least nobody's showing them to him, and nobody else is out there claiming, ownership of those kind of poll ratings. Gavin Newsom, California is a very liberal state with its own problems. He may look good on TV and sound good on TV, but I think it's a difficult sell right now to say he's got a better chance of beating someone like Donald Trump than Joe Biden.
At the same time, there was this poll that had a generic Democrat running against former President Trump, and that generic Democrat won. So there seems to be an appetite for somebody else to come in. So at what point does it sort of behoove the president of the Democratic Party to find that person who could step in? Maybe there just hasn't been the ground research.
Well, Lisa, it would be much easier for the Biden administration to actually find a different vice presidential candidate. Kamala Harris may turn out to be just fine in terms of not being a drag on the polls. But if there was somebody, quote unquote, younger, dynamic, who was more popular potentially, particularly a governor like Gretchen Whitmer, for example, or Raphael Warnock, senator from Georgia, if they could announce that transition and say we're looking to a new team, that may move the needle, right? That may say to voters, he's thinking ahead. He's understanding that we want to know what succession looks like because we are concerned about his age.
Wendy, thank you for your input, as always. Wendy Schiller there of Brown University. By definition, one of the most experienced, Tom. He was elected in 1972 to the Senate. And for a lot of people in this country, that's a weakness, not a strength.
Yeah, I would say it's split. Actually, it's the great divide, as a lot of people would say, yeah, it's too much Washington. And another group is saying, what else do we have besides that experience? But, it all comes back to the gerontocracy and the age of these two key candidates. And, I said this to someone yesterday while I was walking down the street and somebody cornered me. Do you work with Lisa Abramowitz? I said, yes.
They get very excited about that, don't they? Yeah, yeah.
Do you know Abramowitz? What's she really like? And
mean.
A raging diva.
And we were talking about this, and it's upon us. I think the thing we don't understand on December, whatever it is, December Fed meeting, is January's here. Wendy Schiller's province is now. It's like Bramo's in, it's not Bramo, Anne-Marie Horton is in Iowa in what, 3 weeks?
Should we get to the Yellen Fed meeting? This is the Yellen Fed meeting, just yesterday. I personally don't see any good reason to think that the last mile is going to be especially difficult, the last mile of the inflation push. That was Chair Yellen yesterday. Here's Vice Chair Biden on Friday following the jobs number. We're in a sweet spot that's needed for stable growth and lower inflation, not encouraging the Fed to raise interest rates. The Biden-Yellen Fed meeting, Bramo, of the last few days.
Which is a little bit awkward because you're going to hear from Fed Chair Jay Powell, we're not there yet, and the last mile could prove to be difficult. There is a political sell here, and the message is not getting through. And there is a frustration with that, and you can hear that consistently. And people are getting more forceful. Janet Yellen, President Biden saying prices are coming down in certain areas, and certainly inflation is coming lower, and it's not breaking through.
I adore her work and her path. Missing here is Lyle Brainerd. Where in God's name is Lyle Brainerd's voice in this?
There was a nice blog post yesterday, which is worth a read.
I missed
that. Was interesting, yeah. So not totally invisible, but silent a lot of the time. I agree with you.
Enjoy when she speaks. She adds value, whether you're...
Tom, I've said it a million times, they've got two very sharp individuals in the economy.
Yep.
In fact, they've got more than that. Don't hear from them often enough. Equity futures on the S&P positive by 0.1% from New York. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Three-day winning streak on the S&P 500. Equity futures looking at day 4. We're positive by 0.1% on the S&P. On the Nasdaq, up by 0.2. We're looking at an equity market up around about 10% since the Fed last met at the start of November. What a move we've seen between Fed meetings. Let's switch up the board and get to the bond market. 2-year, 10-year, 30-year. Big moves there as well. I think over the same period, the 2-year down about 30 basis points, the 10-year down about 70. We're down to 418.33 on a 10-year TK, on a 2-year 472.42.
Yeah, the 418 has my attention here. The real yield we haven't mentioned this morning, 2.01%. I'm going to call it quiescent. But John, to go back to the equity levels here, and you mentioned a 3-day tear, because we're doing financial media and we're all addicted to the short term. I'm going to call it a 14-month tear from October of last year. Look at the levels, John. 4,700, 37,000. You're sort of in betweeny on the NASDAQ 100, but give me 2 cups of coffee and we'll be 17,000 on the NASDAQ 100. I don't have, I'm not going to speak for other people, I don't have perspective on these levels we're at.
This is a market that's moved really quickly to price in rate cuts for 2024, which tees up the Fed meeting, Bramo. Do we get any pushback a little bit later on this afternoon?
And it strikes me, if we don't get pushback, we've been talking about how that will ignite the next leg of the rally in equities and in risk assets in the bond market. Or is there something else behind this, right? I mean, this is sort of the question that you are asking for a long time, and rightly so, which is there another reason why the Fed might need to cut rates? If there is that concept being priced into a market that has discounted the bearish playbook that we came into this year with that was completely upended and wrong?
Not all rate cuts are created equally, and we'll have that conversation in just a moment. Let's push it through the FX market. The euro against the dollar shaping up as follows. The euro at 107.80. That currency pair negative 0.1%. 2 meetings. Federal Reserve this afternoon. Then on to tomorrow, Lisa. The ECB, and overwhelmingly, the people we speak to suggesting this ECB, if they cut, they're going before this Fed.
And it's because the conditions, the economic backdrop is looking worse over there than it is over here, and the disinflation story is global. If they confirm that, is the biggest move going to be in the currency pair? Are you going to see the Jeff Yu parity call come to play in a much more significant way?
Morgan Stanley's Matt Hornback thinking about the same thing as well. Let's get to your top stories this morning. Under surveillance, we're counting you down to the final Fed decision of the year. The FOMC expected to hold rates steady. Investors will be looking for clues about cuts next year. Chair Jay Powell saying it's too early to speculate on the timing of the first rate cuts. But Andrew Honhorst of Citi writing this. In our base case, the first 25 basis point rate cut is delivered in July, followed by cuts at each subsequent 2024 meeting, accumulating, Tom, to 100 basis points of total cuts next year. Andrew's going to join us very shortly.
And this is the measured issue. Greenspan's measured idea. Do you get back to a quarter-point ballet, and you don't want to do it until you can get persistency of cuts, a sequence of cuts. I always go back to a more traditionalist view is, why don't you just cut rates itty-bitty and then just say, we're just going to stop and continue to reassess?
Itty-bitty meaning what?
25 basis points.
Okay.
And then just...
Isn't that what we're talking about?
No, they're talking about sequences. Hollenhorst is talking about sequences of rate cuts, and we don't want to move until we can initiate sequence. I just think it's good luck with that.
Good luck with that. We'll have that conversation in just a moment. Good luck with that, Andrew.